what we're seeing this quarter is the consumers pushing back. They're saying you can't raise prices.
Inflation, it's high. It's not going to be back to the 2% target anytime soon.
The overwhelming urge, as Jerome Powell stated yesterday, to continue to fight inflation can create a reasonable amount of volatility.
If anything, the risk is that they raise more than what you see priced in the market right now.
We still put the possibility of a recession by end of 2023 at around 30%.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Absolutely brutal. Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Futures down another 1.6% on the S&P. TK, the Nasdaq, down by 1.8.
And the VIX are two big figures, John, and you're really getting out there. 30 is that level of brutal as you just described it. We're out to 33.02. And anything up in the 40 level is the beginning of that cathartic wipeout that everybody's been calling for. Did we get there yesterday? No. With today's action, we're getting there.
Tom, what do you make of the gloom on the south side this morning? Deutsche Bank, we are at the recessionary crossroads. HSBC, those gross risks are right now. Barclays, the risks are firmly to the downside.
When you own equities with a 3-year or longer time horizon, this is supposed to happen. We've got a global Wall Street, John, that has no history of a bond bear market. We're in one big time, and minimal history of true equity sell down, not negative 18%, but John, negative 25, negative 35%. I'm not saying we're going to see that, but that's when you get the emotion.
This is not your regular correction if you're looking at Target down 25% yesterday. Lisa, Dollar Tree down by 14.5%, Costco down by 12.5%, Best Buy down by 10.5%, Amazon, all of this yesterday at the close yesterday down by more than 7 percentage points. That's a problem.
This is a concern about margin pressures and margin compression that we've been expecting to see, and suddenly we do see. Here's what I don't understand about what you were just talking about, the increasing gloom on Wall Street and how that's translating, frankly, into a bid for bonds right now. I don't understand how people are basically saying we're going to be done with this in the short term, and then we can move on and go back to the old order, because right now what we're seeing in a lot of these retailers is a stickier inflation that's going to have a more persistent effect, and a Fed that has to combat that.
Base case on the street right now is near-term risk, ugly. Over 12 months, you get a relief rally into year-end and things get better. Deutsche Bank captured this perfectly. Yesterday evening, Binky Chadha came out with a note. 36.50 in the near-term price target on the S&P, but the base case hasn't changed. The base case, ultimately, is earnings are still decent. Into year-end relief rally, bit of a trim of the year-end price target. They come in from 52.50, but 47.50 is the price target right now at Deutsche Bank. Lisa, 47.50 sounds pretty bullish to me, considering where we are.
And frankly, this speaks to the lack of capitulation that Tom was just talking about. And I was speaking with a very big hedge fund manager last night who was basically saying, we have not seen capitulation.
Wait. You were talking with Ken Griffin last night?
I was not speaking with Ken Griffin.
You
but
saw
honestly,
him at Famous Famiglia, I know.
Looking forward, there is a concern about how to deal with the interest rate sensitivity of a market that does not know what to do with 3 or potentially 4% yields on a 10-year.
We're working out what to do with this. The S&P 500 down another 1.5%. On the Nasdaq 100 down by 1.6%. Let's whip through this price action. That's equities. Here's a look at bonds. Yields 281.72. 2 Mondays ago, 320 on a 10-year. Now about 40 basis points firmly south of that level. In the FX market against the dollar, pretty much everything stronger in G10. Euro dollar just south of 105. At least we're at 104.96.
Yeah, and a lot of people watching this, especially ahead of, in a couple weeks' time, that ECB meeting. Today, the retail earnings do continue. We get Kohl's before the market opens, and Ross Stores around 4 p.m. Eastern time at the close. This follows Target yesterday down about 25%, the biggest drawdown going back to 1987. As you both were talking about, how much do we continue to see these margin pressures? How much is this a shift in the mix of goods versus people really staying away from bigger ticket items and leaving a lot of these retailers in disarray with inventories that don't fit the demand of the moment? Today, we get a slew of economic data, including U.S. initial jobless claims at 8:30 a.m., April existing home sales at 10 a.m. What I am looking at is the breakdown Where are the potential layoffs within the cuts that we see with the initial jobless claims? We're not going to get a lot of them. It's going to talk to a tight labor market. But what about the construction workers? We have seen recently an increase in construction workers that have been laid off as we do see less momentum in the housing market. Does that persist? What does that portend? And President Biden is focusing on shoring up all of his alliances today. We see that with Sweden and Finland leaders joining him at the White House, talking about their bid to join NATO and potential other alliances that they can make. And President Biden is then heading to South Korea and to Japan to kick off the Indo-Pacific Economic Framework. This comes, John, as we get a lot of words out of China about Taiwan. What is the next shoe to drop in this geopolitical melee that we have here?
I know, Bramo. Thank you, Lisa. Thanks. TK, right now, this administration and society facing some real wealth destruction coming out of this equity market. Then you've got the issue with energy prices, gas prices as well. This is a really tough moment for this White House.
It's a White House moment, but also a global moment, John. It's going to be a huge theme for me at Davos. I actually was on the phone yesterday with the World Economic Forum talking about the set of totally unusual risks. I actually, John, cut a person off in the middle of the conversation. Heaven forbid, John, I know you're shocked that I did that. And I burst out, I said, do you understand there's a war in Ukraine? There is. Here's the data point right now, John, that sums the risk. Euro-Swissy is almost 4 standard deviations from +2 weak Swiss to -2 strong Swiss in 2 days. That is a new safe haven field.
Joining us now is Max Kettner, the Chief Multi-Asset Strategist at HSBC. Max, your point, your lead point this morning is that this growth shock is right now. It's not 12 months out. It's right now. What you've also got to help me with, though, is that your S&P 500 price target, yes, it's come in from 4,900, but it's still 4,450. So can you reconcile the two things for us this morning, Max?
Yes, good morning, John. I guess, in terms of the growth shock, there is a temptation, really, to say that we've probably got another 12 to 18 months time to go, and then things will turn eventually, so there's no real risk on the earnings side. The risk right now is that when we look at equities so far, the derating that has happened was purely really a function of valuations. It was purely a function of multiples. On the earnings side of things, nothing has really happened so far, right? If we look at earnings estimates for this year, they've barely budged for global equities overall. They're pretty much flat year to date. Now, when we look at some of those sectors, consumer discretionary, tech, particularly industrials, they're looking at increases year over year of 15 to 20%, which looks illusionary, wishful thinking, la la land, take your pick, right? It looks just outrageously too bullish on the earnings estimate side of things. What we do, however, think is if we do get that growth shock now being priced in, which looks quite likely that is going to happen over the summer months, and then we start the end of Q3, Q4, in an environment where China will have stimulated a little bit more, the credit impulse has already turned, growth expectations, particularly top down, will have been slashed even more. So the bar to beat, the bar for positive activity surprises, is very, very low then. Perhaps even more people got sucked into the long dollar trade then. So financial conditions will then probably have sort of maxed out then. And perhaps by then, we'll see perhaps a little bit more evidence of the Fed pausing once they're at neutral. And all that should be giving a tailwind, however, not really in the next 4 to 5 months. It's way too early to position for that. But from the end of Q3, Q4, that's when we're really starting to get a few more positives coming through.
Max, how much does your constructive view down the line, not in the next 3 to 6 months, but perhaps 12 months' time, really rely on basically the Fed blinking, right, and actually pausing, like you say, and not going as far as they say that they're going to go, and seeing inflation roll over in a way that we're not yet seeing it or any signs of it?
Yeah, I think quite a lot, right? It is obviously a mix of things, right? It's a mix of activity surprises perhaps starting to be more positive, expectations coming down, more stimulus out of China, dollar perhaps rolling over at some point, all those sorts of things in combination with the Fed. But perhaps the Fed and the Fed put eventually is probably the most important one. I guess the big risk scenario is that come September, we're roughly at neutral perhaps on the Fed funds rate. And then the Fed says, well, actually, we might have seen a growth shock, but we haven't seen anything in terms of inflation data rolling over. What Powell was saying yesterday, we haven't seen any sort of evidence of that yet.
Yeah.
So our second mandate, unemployment growth mandate, will kick that in the background. We cannot be here for markets or growth now. That means we're going to go full Volcker style, and that would probably be sort of the bear case, S&P down to 3,000. In our view, really, it's sort of, we think that over the summer, the S&P could touch down to around about 3,600. And that would be pricing equities versus rates, for example, for recessionary territory, well into recessionary territory over the summer. And thereafter, things could be a little bit better.
Max, just to jump in with a final question, sir. Credit to you, first of all. You've been very, very cautious through most of this year, so upfront credit to you. Just want to build on this. There's a lot of people, I think, receiving the same information from Wall Street at the moment. It's that near-term cautious, long-term relief rally, which essentially is what you're calling for, Max. For many people still in this market holding on, they're seeing the losses pile up week after week after week for the last 7 weeks. Max, what's your advice to them as they sit there, hugging the index still, getting absolutely hammered, hearing people on Wall Street say near-term, yeah, this is a mess, but long-term relief rally?
Yeah, it's a very interesting point you make, because what we are doing is we're tracking actually positioning across the largest real money accounts worldwide. And what we have seen in the last couple of months is not capitulation. What we have seen is back to hugging the benchmark across everything, across IG credit, high yield credit, duration equities, across everything. Get back to neutral everywhere. What that tells you is that the near-term pain could be so severe that you just cannot look through it. You cannot simply say, well, over the next 12 to 18 months, eventually it should be better. So let me just write this out by being neutral. I do think when we look at parts of credit, particularly dollar credit, there really isn't enough pain in there yet, right? Triple Cs have started moving. But both, let's say, if we look at spread differentials, triple Bs against single As, or even still triple Cs against double As, they are nowhere near recessionary territory yet. So there needs to be more pain, and that's why people hugging the benchmark is not sufficient.
It's a difficult moment, Max. It's super difficult, buddy. And it's great to catch up. Max Kentner there of HSBC. Bramo, credit, spreads, just starting to break out a bit now.
Yeah, that's the right way to characterize it. Not yet recessionary territories, as Max was saying, but you're starting to get the feel that people are getting nervous.
Futures down 1.4% on the S&P, on the Nasdaq down a similar amount. From New York, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. China's top diplomat has again warned the US about its increased support for Taiwan. In a phone call with National Security Advisor Jake Sullivan, Yang Jiechi said the US is going down the wrong road and that could lead to a dangerous situation. Earlier this week, the top American naval officer said Taiwan must prepare itself against potential Chinese aggression through military deterrence. And the world's richest person saw his wealth shrink by more than $12 billion in just one day. Tesla fell to the lowest level this year, knocking Elon Musk's fortune down below $210 billion. Musk has lost $49 billion since launching his bid for Twitter last month. Part of that is due to the wider market sell-off, plus investors in Tesla are concerned about how Musk will fund that Twitter bid. President Joe Biden has invoked emergency powers under the Defense Production Act to try to boost production of baby formula. He's also ordered that government planes be used for imports. The baby formula shortage has emerged as the latest crisis for the White House. It's been months in the making and could ease soon when production restarts at a key plant. And Sri Lanka has fallen into default for the first time in its history. Policymakers had flagged to creditors that it wouldn't be able to make payments within the grace period. Sri Lanka's government has been struggling to halt an economic meltdown that has prompted mass protests and a political crisis. Authorities warn that inflation may hit 40%. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Well, I think it's very useful to front load our policy settings at the moment. We did 50 at our last meeting, and it's extremely likely that 50 at the next meeting and, probably thereafter.
That was Charles Evans sitting down with Michael McKee. Charles Evans, the Chicago Fed president from New York City this morning. Good morning. This market feels like you're getting punched in the face every single day. Futures down about 1.4% on the S&P. On the Nasdaq, we're down 1.5%. Yields come in. That inverse correlation between treasuries and equities sticks. So treasuries rallying, yields lower by 6 basis points. Tom, your 10-year, 281.90.
It's Thursday, John. This weekend, are we going to begin to see people talk not about July 27 meeting, but the meeting before that?
I don't
wonder
think so,
if
Tom.
we're pulling it back.
I think that's what's interesting about all of this. So far, I'm not going to predict the future.
I agree.
I'm just going to go on what we've heard.
So far, it hasn't happened.
So far, it's not happened.
Yeah,
and if I go back to what I think was the most important Fed speak we've had in the last couple of weeks, and I promised I'd say it repeatedly, it's what we heard from Mary Daly of the San Francisco Fed.
Yes.
When she said, I expect financial conditions to tighten more. I leave this quote on my computer almost every day at the moment. I would like to see continued tightening of financial conditions. Now, I want to go back to what Goldman said. This is why Goldman have a 3-month price target of just 4,000. They think we're capped here because any rally in equity markets is considered a loosening of financial conditions and perhaps perceived by the Federal Reserve as an unwarranted loosening of financial conditions. That's the struggle in this equity market. We've gone from a put from the Fed and now almost, for some at least, for some, with a ceiling.
John, we don't have the time for it here, but we're through one standard deviation on the Bloomberg Financial Conditions Index. And I'm sorry, if that continues down and breaks through about a 1.20, that's a big deal. And maybe we see, even into this weekend, a change in the dialogue. All of that wrapped around international relations. Mark Champion owns the high ground. He is in Glasgow, Scotland, which I can't pronounce as well as John Ferro. And Jack Fitzpatrick, who knows how to pronounce Glasgow, is in Washington. Mark, I got to go to Jack on the Biden trip because, Jack, to me it is absolutely hilarious how we're turning TPP into IPEF. Secretary Clinton, I'm against the Trans-Pacific, whatever it was, TPP. President Trump, I'm against TPP. And all of a sudden we've got the Indo-PEF. Jack, what's going on here?
That may not be the absolute main focus of this trip. It's going to be interesting to see exactly how they sort out the Biden administration stance on trade, although really what the White House officials have previewed for us regarding this trip is that China and sort of trying to make a display of unity among democratic countries is a major focus. So I don't know necessarily that we'll get all the answers on trade policy looking to Asia, although clearly the sort of saber-rattling comments from the Chinese diplomat regarding Taiwan are a major focus, and that's seemingly the sort of top of the docket for President Biden's trip to Korea and Japan.
What is the best outcome coming back? I mean, if we begin to talk about a one-term presidency, Congress is dead set against TPP of a couple years ago. Mr. Trump scored major points with that. What's his best outcome when he returns on Air Force One?
I don't know that they necessarily have a list of goals that they think they can check off that are concrete goals after this trip. The president's focus on East Asia is a little bit more nebulous than that. As I mentioned, kind of sending the right message to China and setting some sort of long-term stance and understanding there seems to be the biggest, broadest goal. So I'm not sure they're going to be coming back saying we have this and that and this accomplishment at the end of this trip.
Meanwhile, Mark, before President Biden leaves, he's going to be meeting with the heads of Sweden and Finland about their bid to join NATO. We know that Turkey has been a sticking point. What does Turkey want, and how far away is that concession to get Sweden and Finland into NATO?
Right. Well, Turkey has been at odds, really, with the U.S. and a number of other NATO members, including Germany, about the treatment of the Kurds. From the Turkish standpoint, some of the Kurdish groups that the Americans fought alongside with in Syria, and increasingly also the political representations of Kurds within Turkey, whose leaders are now in jail. These are all grouped together by the Turkish leadership who considers them essentially terrorists. Some of them are listed terrorists, both in Turkey and in the US and elsewhere, including Sweden. Others are not. But because the Swedes traditionally have been a kind of safe haven for refugees from conflicts and from oppressive political systems, that the harder conditions have become for the Kurds in Turkey, the more have gone to places like Sweden, and they've been harbored there. And so essentially what Erdogan is saying, if you want to join NATO, you're going to have to see the Kurdish issue the way that we do. You're going to have to say that you do so. And that is actually politically difficult within the Swedish political system, because there are Kurdish representatives who are quite important to a federal coalition. So it is tricky. Most of the diplomats involved seem to believe that a solution will be found. But Erdogan is not always a team player within NATO, or he has a pretty prickly relationship with the US already. So it's not quite predictable.
Mark Champion, thank you. Jack Fitzpatrick, to you as well. What a tough moment on so many fronts. Crude right now, Brent, 108.22, negative 0.8%. TK, WTI, 108.08. We're down about 1.4%.
Churning, and I would say the same for the dollar as well, with a 103.48 on DXY. There's a lot of things to watch here, John. Of course, we're all driven now by the equity markets and to an extent the bond market. But this is where, with the Bloomberg and going cross-asset, as we heard from Max Kettner with HSBC, you look at the nuances of the moment. My nuance this morning is the safe havenness of the last 24 hours. You like that?
What do you make of the rally then, Tom, in the Aussie? The fact the Aussie's up. It just feels like a weaker dollar story this morning, for me at least, against the whole of G10.
Yeah, I think it's a weaker dollar story, but it's fractional. Within the 2 standard deviations study, it's within the band, it's contained. If it goes further, yes, that's a big deal.
Relationship between bonds and equities has re-established itself, Lisa, over the last few weeks. You see yields down, equities a whole lot lower.
I don't really understand this. I'll be really honest. It seems like right now the market thinks that the Fed's going to blink. You could see two-year yields actually dipping a little bit. It's sort of the whole Max Kettner view of the world, that inflation will come down enough and that, frankly, growth will slow enough for the Fed to back away. The rhetoric is going in the opposite direction.
Isn't that the hope at the back end of summer? I just hear it so many times from so many different banks. Goldman, HSBC, Deutsche Bank. The base case is a rough 3 months, and then the Fed backs off and things get better.
Yeah, predicated on them blinking. And they're saying, we're not going to blink. This is a new moment.
Futures, it looks ugly. The Nasdaq down 1.4% after a pretty brutal session yesterday. From New York, this is Bloomberg. Live from New York City this morning. Good morning to you. Pretty ugly price action yesterday. The follow through -2 on the S&P 500, down by 1.4%. On the Nasdaq 100, we're down about 1.5%. Deutsche Bank says we're at the recession crossroads. Barclays say risk remain tilted firmly to the downside. And HSBC and Max Kettner about 30 minutes ago, said the growth shock is right now, not 12 months out. It's right now. For Deutsche Bank, they've got an interesting call. In the long end, things get better, relief rally. You'll hear that a lot on Wall Street. In the near term, the average recessionary decline, Binky Chowder did some work on this, is negative 24% on the S&P. So that would take us down to 36.50. That's the near-term call from Deutsche Bank, just to price in the average recessionary decline of 24% on the S&P. Something to think about as we work our way through this market and work our way through what many people consider to be, will be, an ugly summer. At the moment, what has re-established itself is the relationship between this, the equity market, and this, the bond market. The push-pull continues. 2s, 10s and 30s. Your 10-year yield comes in about 5 or 6 basis points. Again, yields lower, 282.62. Just to think about the levels more recently, Tom. 2 Mondays ago, 320.
Exactly.
Yields all the way in.
John,
2-year yields, we topped out this year at about 285. Tom, right now, 262.19.
John, 2 glasses of Tang ago, we were at 3% in the 10-year yield. We've moved 18 beeps in a glass of Tang.
And re-established that relationship that we're used to, that negative correlation between equities and treasuries. Equities down, treasuries up. Lisa, yields lower.
Which means that people expect that inflation to come down, and for the Fed, especially because of the front-end action, is not going to raise rates as much as they say. Is the data backing that up? I'll leave that to other people to decide.
Growth right now dominating the story, not growth equities, growth fears. Let's finish on the last board, euro-dollar. Euro-dollar at the moment going into a really important meeting. How many times have we said that for this ECB? Euro-dollar 105, that currency pair positive 0.4%. Just across the board in G10, TK, you're seeing some dollar weakness emerge on a session this morning.
Target weakness this morning as well. Don't know where it is right now, but Joe Feldman with us yesterday with Telsey Advisory Group. This is an example of what you're seeing on the street. He maintains outperform on target, but lowers the price target big time from a 305 down to 200. Those are the micro adjustments being made. Patrick Pelfrey is co-head of quantitative research and senior equity strategist at Credit Suisse and is looking at the macro adjustments. How are you using the micro changes of your sell-side research team, Patrick, this morning?
Well, when we talk with our analysts and we go through the transcripts and we look at where earnings estimates are moving, everything on the fundamental front seems very much intact. 2022 estimates continue to rise. There's certain sectors, communications in particular, which is seeing pressure. But generally speaking, estimates are holding up quite well, including revenues. Margins a little bit less weaker, but still enough to propel the earnings forward in a meaningful way.
This is important, folks, because Credit Suisse hit the ball out of the park 18 months ago with a wonderful barbell strategy of bullishness. Patrick, if you've got a constructive view like that, are we over-focusing on margins and not looking at a pretty good or good revenue lift based on nominal GDP?
Well, Tommy, I think you're absolutely right. Companies live in a nominal world. I know as economists, individuals like to talk about real activity and they like to piece out inflation, but companies for the most part don't really matter. They are oftentimes, in most cases, able to pass that on. And we're seeing that come through with revenues this year expected to be plus 10%. That's an incredibly strong number. So with revenues that strong, there's an ability to give up very incremental margin to see the earnings picture still be up 8 to 9%. And that is spectacular for this point in the cycle.
What are you counting on in terms of rates to get you to that level in equities based on the fact that not only do you have, yes, you've got the nominal growth, but you also have a revaluation based on higher inflation and, frankly, based on a Fed willing to raise rates much beyond what people had imagined a year ago?
Well, it's a great question. And I think really what people are trying to understand, there's a lot of pieces moving around here. And our focus is really here on valuation. That's really where the biggest distortions were at the beginning of the year. We started with a 21.5 multiple. We're down to a 16.5. That's roughly in line with long-term averages. But more importantly, expensive companies were extremely expensive, and that's where all the pain has been. You see that in secular growth themes. You see that in technology, communications. When you look outside of those groups, valuations look a lot more reasonable. The pain looks a lot less meaningful in those groups. This has been a valuation re-rating because of higher interest rates, and that's a meaningful part of the discussion.
Which sounds all very logical, and it's easy to then come on and say, look, if I like those stocks before, they've been on sale, let's buy them. But it doesn't count for the behavior of investors who see their statements and say, holy cow, we've got to get rid of this. We've got to actually start selling. We haven't seen those kinds of mass sales. How much of an overshoot to the downside could we see before we get to what you expect to be a rally?
Well, I think we're pretty much getting close to that bottom now. Like we've highlighted earlier in the show, 20% right now is really where the S&P is down. Historically, in bear markets, we see it down a little bit more, but that tends to be recessionary. Right now, we have an incredibly strong economic outlook. Certainly, inflation is a concern, and I agree with that. But right now, nominally, GDP is expected to be 9% this year, with real GDP being 3%. That doesn't feel recessionary to me.
This is really important, folks, what you're hearing here, this nominal versus real argument. Patrick, let's say we've got a nominal glide path. I'm going to call it harmonic. You go from 9%, as you state, to 4.5%. Maybe we get down to 2.25% at some point, Japan-like. But within that time frame, corporations adjust, and they adjust use of cash. What do you, as optimists, feel use of cash will be starting now into the summer and into the budget outlook the corporations frame for 2023?
Well, companies are always very rational with how they deploy their capital. Right now, we've seen shifts towards dividends. We've seen increasingly shift towards buybacks. We've also seen a shift towards CapEx. I think all three of those areas are going to continue to see growth. We're seeing areas like dividends and CapEx get rewarded a lot more than buybacks. So companies shifting that way are going to likely see better returns than perhaps going directly towards buybacks. But there's ample capital on many of these companies, particularly large cap companies, given how strong free cash flow is. And we expect them to continue to use that.
Well, a ruder way to ask Tom's question is, are they going to start to lay off people in order to save costs, in order to increase their margins, especially as you get the likes of Amazon and Walmart talking about how basically they have too many people paid too much based on the shift in appetite by consumers?
I think as long as the demand is there, companies are staffing to meet the level of demand. They're not staffing to meet stock market gyrations. So yes, the market's down, and I think investors are assuming that's going to impact companies' decisions. But a company doesn't say, I'm not going to meet your order because my stock is up 20%. They say, no, you want an order, I'm going to supply you with that order. Depending on how much demand declines from here, that's ultimately going to depend on how much staffing they need. Right now, the GDP backdrop still remains quite robust. Labor market remains incredibly tight. Does that weaken incrementally? Perhaps. But I don't see that as being a huge catalyst in the story here. As
Patrick,
just
to jump in, because I think this is really important. I know that companies don't base what they need to supply the company with based on what's happening with the equity market, but I would say some of the C-suite right now, they are worse at calling their own company than some people are on this show calling this market. And that's been the problem. These companies have set themselves up for the demand of last year, and it's not there anymore. We saw that with Target. We saw that with Walmart. We saw it with Amazon. Patrick, we've got some stuff to work through here. Don't you agree?
I do think we agree, and I think there's areas of the market that are particularly under pressure. Discretionary is an area that's probably going to be weaker. I think technology is an area that's going to be weaker as well. I think investors need to be selective in where they look at the opportunities for companies. I mean, we're investing, we're encouraging investors to look at cyclical-oriented companies like energy, materials, industrials, things that benefit more from this backdrop and are less exposed to some of the issues that are happening perhaps with technology and with some of the issues with the consumer at the moment.
Great to catch up, Patrick. As always, to get your view, your perspective.
Brilliant.
And send our best to Jonathan as well. Patrick Palfrey there of Credit Suisse. Very difficult, Tom, to find the right balance in this economy right now.
You got to find the right belief. This is where your belief structure, John, matters. You have to have an outlook. You have to have, I mean, I make jokes about the triple leveraged all cash fund. And John, I am considering, somebody asked, are you going to fourple leveraged? And I said, it's under discussion right now with my advisors. But John, critically important, you've got to have a belief structure which starts with economics and then, frankly, as you heard from Mr. Palfrey, forces its way into corporations and their financial decisions.
And it looks like some of these corporations made a very bad call last year. Let's work through it. You saw it with Target, with Walmart, with Amazon. There's no air about it. Carry on making that noise. They built out capacity aggressively. They got all the staff back. Tom, they built up inventory, supply, all of that stuff. And look where we are. Look what's happened with Peloton, with Target, with Walmart, with Amazon. There's too much capacity, Tom. They've told you that on the call.
And you're right, they and all of us are making it up as we go out of a pandemic. And the optimism I would have, John, is they will rapidly right-size off of the shock of what we've seen the last 2 days.
Lisa, everyone was hoping
be at light speed
for a supply-side recovery. What's happened is that demand is taking over. And that's what we're hearing. I mean, I'm not an economist. I'm not trying to be one. I just listen to what the companies are telling you, and that is what they're telling you right now.
And frankly, this has been the issue. You've been looking for a supply-side response that has not come because of what's going on in China with the lockdowns there and the Ukrainian war. You're looking for all of the workers to come back into the market, but which workers and to what jobs? And all of a sudden, you have these structures of the corporations paying that much more to individuals at a time when the consumer appetite is changing at light speed. How do they maneuver, John, even with nominal growth, even if you strip out the concept of inflation?
Equity futures on the S&P down 1.3%, on the Nasdaq 100 down by 1.4%. Coming up, we'll catch up with an economist, a brilliant one, Claudia Sam, the Director of Macroeconomic Research at the Jane Family Institute. Joining us next on this program with Tom Keene, Lisa Abramowicz and Jonathan Ferro. For our audience worldwide, heard on radio, seen on TV, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. There's a sign that Beijing is strengthening its energy ties with Moscow, just as Europe turns towards banning imports. Bloomberg has learned that China wants to replenish its strategic oil stockpiles with cheap crude from Russia. The strategic reserves are tapped during times of emergencies or sudden disruptions. President Biden meets today with the leaders of Finland and Sweden to discuss their bids to join NATO. Turkey's President Recep Tayyip Erdogan is opposed to the move because of the two countries' stance on Kurdish militants he considers terrorists. Turkey called on NATO members to do more to address its security concerns. In London, police have wrapped up their high-profile Partygate investigation that caught Prime Minister Boris Johnson. More than 126 fines have been issued over COVID rule-breaking parties held at Downing Street during lockdown. None of those fines was identified. British Airways owner IAG has agreed to buy 50 Boeing 737 MAX jets. That's a lift to the struggling plane maker, and it concludes a widely watched commitment for 200 aircraft that was reached 3 years ago. The 50 planes have a list price of about $60 billion, but IAG says it's negotiated a substantial discount. Gabe Plotkin is shutting down his $7.8 billion hedge fund, Melvin Capital Management. More than a year ago, the fund was grievously injured in a GameStop short squeeze by amateur traders who organized on Reddit. It never recovered. A comeback effort showed initial promise, but unraveled in recent weeks. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Going forward, if there are no significant changes in the data in the coming weeks, I expect 2 additional 50 basis point rate hikes in June and July.
Nothing's changed for them just yet. That was Patrick Harker, the Philadelphia Fed president, speaking in the last 24 hours. Live from New York City this morning. Good morning. Equity futures shaping up as follows. I'm afraid to say for the equity bulls, more pain ahead, perhaps. Equity futures down by more than 1% on the S&P, down by 1.2 on the Nasdaq. The good news, we're off session lows, and I have absolutely no idea if we'll be in the same place in about 5 minutes' time. Yields lower by 6 basis points on a 10-year, 282.62. Yields lower, treasuries firmer, and in the FX market, Tom, the dollar a whole lot weaker, euro dollar 105.23. That currency pair firmer, positive by about 5 or 0.6%.
Continue to moderate at a better tape right now, John. Dow futures negative 338 off of negative 400 earlier. I'm going to call it, John, what, an easing here in the last 20 minutes?
A little bit, Tom, but it's hard to read into it, isn't it? How many times have we been caught offside over the last couple of months?
6:48 Wall Street time. We welcome all of you on radio and television. She created a firestorm in her last appearance with us. Claudia Sahm is cooled off. She's director of macroeconomic research at Jane Family Institute. Claudia, it's amazing and sad how I remember papers from years ago. And I remember a guy named Mankiw at a small school on the East Coast writing with a kid who looked like he was 16 named Justin Wolfers. And they wrote a paper, Disagreement About Inflation Expectations, 20 years ago. Nothing's changed. We've got disagreement right now about inflation expectations. Claudia, if we get a growth slowdown, do we disinflate?
Well, we're going to, as growth slows, and we have room to slow, like we are experiencing really fast growth right now. And yeah, prices, the rate of increases in prices, inflation is going to step down. Now, it's a big question, how quickly consumers, stop going out and buying more and more. And that means it's a question, how slow or how fast or how slowly inflation starts stepping down. There's a lot of factors, but I mean, supply and demand make
there
prices,
we go.
Right?
Sam, Professor Sam, killing it with her. For those of you on radio, you just missed the famous Sam Marshallian cross. She absolutely nailed that. Claudia, I see 2 things right now. John's been great about giving us the equity gyrations and Lisa the bond gyration. I see the financial conditions once again tightening up. The Bloomberg Financial Conditions Index goes down. It's not through the new lows, but it's getting there quickly. Does the market do the work for the Fed so that we completely have wrong our parlor game of Fed guessing out 1 year?
Yeah, so the heavy lifting is going to be done by the American consumers, right? They're the ones deciding, do we rotate back from goods to services? Do we slow it down a little bit in terms of the shopping? And part of that, I mean, like, people do look at their wealth and decide I can spend out of it, or I feel comfortable spending because I know I got a little back on the side. But frankly, it's income. Income is the big determinant of spending for the vast majority of Americans. So yeah, I mean, the wealth effect, stock market comes down. That takes a little bit of pressure off consumer spending. The Fed is looking for this. I mean, they ain't going to say, yay, the stock market is down, but it does move in that quote unquote financial conditions, but it is not enough to really move the needle in terms of demand and then of inflation.
Especially because the consumer right now, even if their incomes are not keeping up with inflation, are still borrowing an increasing amount of money. They have traditionally been under-levered over the past year or 2 years, and we're hearing from a growing number of economists and analysts. They are starting to borrow again to support their spending, even as the stimulus checks run off and their incomes don't keep pace. Does that concern you? Should it concern the Fed and get them moving faster to get ahead of that?
Well, I think we need to keep in mind that during the pandemic, the 2020, in a very unusual way, debt went down, debt relative to income. I mean, the people were not spending, they were being able to pay off debt. This is so not common in a recession. So in some ways, we're getting back to normal. But I will say we still, there's clear evidence that households, including lower income, lower wealth households, that they have built up a little bit of a buffer, and also very unusual to past recessions. But yeah, the Fed needs to see it cool down some.
So when you talk about unusual versus past recessions, you're kind of going toward the elephant in the room, which is the stimulus plan. An increasing number of politicians have been blaming the Biden administration for going ahead with the additional round of checks. In March of 2021, when we were emerging from the pandemic, and the whole idea of how big was this, how much too big, and how much is this really fueling the inflation that we're seeing, can you give us a sense of where you question your own beliefs on this front? I know that you think it was important to give those stimulus checks out to the people. Where do you question the methodology that was executed?
Right. Well, I've written recently that one thing we can do for next time is tie the stimulus to economic conditions. Like, the last check should not have been the biggest check, right? But it was very political. Then President Trump just pulled $2,000, out in thin air. So we can do better, but I remain convinced, and we will learn this as we go forward, that that last stimulus gave us a cushion in a way that other countries did not get, and this could easily be the difference between us not going into a recession and other parts of the world going into it. Like, we've got a little bit of a buffer. But it also absolutely contributed to inflation.
Claudia, did you just blame President Trump for a bill that President Biden passed?
Well, like the flag was planted, right? It was,
Come
and
on,
again,
Claudia.
no, I'm serious. It was very instrumental in the Georgia runoffs, for example, right? Like, they didn't early on. The Democrats could have said, no, 2,000's too much. And there were, frankly, some Democratic advisors who were saying that very clearly at the end of this year. But to me, it's like $2,000 was better than $0, right? And it's absolutely not the only contributor to inflation. The inflation that's got a lot of Americans really hurting and angry is food and gas. And, like, that ain't the rescue plan. Right, we're seeing that inflation hit Europe particularly hard. I mean, that's related to Putin's invasion of the Ukraine. But, like, we were going to have higher prices anyways, and the rescue plan gave Americans a little bit of a buffer.
Claudia, Sam, thank you, as always, from the Jane Family Institute. Looking back over the last 18 months, Tom, difficult to look back and come up with an idea that gets everyone to agree with it. But right now, Tom, we've got a problem. And right now, politically speaking, the White House has got to try and deal with it ahead of the midterms.
As you mentioned earlier, John, and I really, and this is something, folks, it's the hallmark of Bloomberg surveillance. We refuse to go narrow. We refuse to just focus on the stock market and the rest. The set of risks now, John. I just looked, John, thank you, Javier Blas, at Australian coal, Newcastle coal. John, never before have we seen what we see in coal shipped out of Australia north.
I mean, I've never seen a guest come on the program, Tom, and blame the former president for a bill the current president signed.
That's the politics of it, and Dr. Sam is in the heart of the politics.
Getting ridiculous. This is Bloomberg.
What we're seeing this quarter is that consumers pushing back. They're saying you can't raise prices.
Inflation, it's high. It's not going to be back to the 2% target anytime soon.
The overwhelming urge, as Jerome Powell stated yesterday, to continue to fight inflation can create a reasonable amount of volatility.
If anything, the risk is that they raise more than what you see priced in the market right now.
We still put the possibility of a recession by end of 2023 at around 30%.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
What a moment for this market. Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferro. Futures down about 1% on the S&P. On the Nasdaq TK, we're down 1%. Also, the good news, we're off session lows.
We're off session lows of an hour and a half, 90 minutes ago as well, John, but it continues on here. And what it is a massive recalibration across what we do, economics, finance, and investment. And I got to admit, the chit-chat, just as we have with Claudia Sam, is going to start with economics. John, what does any given central bank do, given the cards dealt in the last 48 hours?
Well, if you're listening to Chairman Powell, Tom, you keep on hiking. And I imagine there's a relationship there between what he's saying and what's happening with this market. Deutsche Bank saying overnight, Tom, we are at the recession crossroads for this market. Near term at 36.50, and then the range of outcomes is wide, wide, wide.
We've never seen this, and particularly, John, I sound like a broken record. John, a record is a thing that spins around and you put a needle on it. John, a broken record, the bond market is leading the way. We're seeing real carnage in the bond market, and I'm sorry, the central banks, in some way, facing warm.
Would you like me to count you in? I can do it. Would you like me to count you in?
Yeah,
3, 2, 1.
Face-saving form. Nice cue.
No, that was beautiful,
Nailed it.
Tom.
And what's important here, John, is they're going to blink, they're going to adjust, they're going to adapt.
Hey, that's what you think, Tom. But right now, in this market, they're worried that the Fed won't. And that's why we're seeing some of this price action evolve. Lisa, exacerbating the trend yesterday, the retail numbers, it's all stacking up from Amazon to Target to Walmart, and now Kohl's
coming out actually with their expectation of a much lower multiple coming out, expecting full year adjusted EPS of $6.45 to $6.85 from the $7 to $7.50 that they had previously expected. Also, with the earnings per share coming in well below where people had expected it for the first quarter at 11 cents versus the estimate of 71 cents. How much is this a repeat, a redux of what we saw in Walmart and Target? How much are we looking as Kohl's shares tank pre-market, down more than 6% right now? How much are we looking at consumers pushing back, not buying goods because of the high prices as they transfer their money to other areas, and frankly, CEOs that have not prepared for this?
Well, it was down 11% yesterday. It's down another 6%.
I know, exactly.
In early trading.
Carnage.
Retail got hammered over the last couple of days. Lisa, finding the right balance in the C-suite right now is clearly something they're all struggling to do. Going from this really strong positive demand shock of the last 18 months, they tried to ramp up capacity, tried to get the supplies in, build out inventory, and they arrive in 2022 facing a very different moment.
And right now, this is about margin compression, right? Because what we're seeing is that the revenues, the nominal sales are coming in strong. This sort of speaks to the point that Tom was saying before. There is more money in the system. People are spending it. The actual revenue in the first quarter was above where the consensus thought it would be at $3.72 billion versus $3.68 billion that was expected. This really speaks to the costs that they have to manage. How do they manage those? And how does that bleed into sentiment?
TK, what a moment to be a CEO.
Well, to be a CEO or portfolio manager, I think everybody's aging. John, this is the way it's going to work. It always, always, always works this way. You do late summer, autumn planning into 2023, codified on Wall Street into February bonus. Other corporations are different. all of that, John, with a vengeance, is going to be pulled forward into June.
Let's whip through this price action. We are down about 1% on the S&P. Yesterday was ugly. Some negative follow-through on the Nasdaq 100. We're down by more than 1 full percentage point. To the listeners out there, Dale writes in, you would have been proud of my kid this morning. The Dow Jones plunges this morning. No one cares about the Dow Jones. Bramo, that from a 12-year-old listening to Bloomberg Surveillance this morning.
I love that they're giving you pep talks with their children as they talk about the Dow. Okay, well, it's a life that some of us do have as well at home. All right, today, those retail earnings very much front and center. Kohl's, as we were just talking about, just reporting. And this follows Target's carnage yesterday, down more than 25%. The biggest drop in those shares going back to 1987. Walmart with a similar trend the day before. How much is this a story of margins? Yes, on a nominal basis, people are spending more money because things cost that much more. But that is not translating into profit. And how do they square that, given the fact that they're paying so much more for labor, for the materials, and frankly, compensating for a disruption in what people are buying at a pace that we have never seen before? Today, economic data includes U.S. initial jobless claims at 8:30 a.m. and April existing home sales. I am watching the mix of potential job cuts because this really speaks to how different companies are right-sizing. What about the builders? That is where we have started to see weakness because housing, frankly, has started to show signs of being a little bit nervous in the face of interest rates that are so high, mortgage rates that are so high, and the material costs that also are so high. And what you're seeing is that a potential rollover in the number of construction workers could portend further weakness in the U.S. economy. And meanwhile, today, President Biden is focusing on alliances of all types. We have Sweden and Finland's heads coming to the White House this morning and talk about how they're going to make a bid for NATO. I'm sure Turkey will be a big discussion as a sticking point and what they're willing to give. And then President Biden is heading to Asia for the Indo-Pacific Economic Framework. John, we are talking about one geopolitical crisis to another. How do you account for some sort of disruption in Taiwan as China really comes out and says that what the U.S. is doing in terms of rhetoric is starting to get a little bit dangerous to them?
I can't even get there. Honestly, I just can't even get there.
I know, which is the reason why people aren't talking about it.
It's so hard to even focus on an additional thing right now, Tom.
It's exactly right.
Given everything that's happening.
Well said. The only one on the planet that's going to care about this trip is Anne-Marie Horton, and what the hell does she know?
We'll catch up with AMH a little bit later. Laurie Heinel joins us now, Global Chief Investment Officer of State Street Global Advisors. Laurie, you've got that big cash position. You can talk to us about how big that is. What are you waiting for to deploy it?
Well, first of all, there's a lot of uncertainty out there. So I would say the biggest theme around our portfolios right now is less about the directional trade and much more about the relative value. So we've been trading around different markets, deploying capital into the U.S., which we thought was still a bit of a safe haven relative to other regions, but also looking at places like commodities, looking at places like gold, and as you say, holding a bit of a 5% cash position right now.
Laurie, you are the perfect one to talk about right now. And folks, this is the esteemed chairman of Bloomberg, Peter T. Grauer, telling me in times of stress, you see transactions and combinations. Kohl's is flat on their back. They have just announced, within all the troubles of Kohl's over decades, board thoroughly testing standalone strategic plan. Are we going to see one big roll-up, Laurie, of American finance and corporations out of these risks and challenges?
Well, every situation is idiosyncratic. And one of the things that's striking about the recent announcements on the consumer side is that we've known for a while that consumers were likely to move from more goods-oriented purchases to more service-oriented purchases. And while we certainly have had some of the news out on some of those retail franchises, the other side of it is you've got airlines and other service providers that are actually seeing very good demand and actually having some pricing power. So it's not just a one size fits all. There's going to be a lot of idiosyncratic behavior, and companies that can think about what their exposures are and how to hedge those and where they do have pricing flexibility or power, those are the ones that are going to survive.
I can't emphasize, Lisa, enough the need here to be one size is wrong. Target, 450,000 employees. Kohl's, 35,000, and yet people like to compare the two. They're completely different, including the 10-year total return, Target gets it. Kohl's has been a disaster.
Right, and we can talk more about the two distinct stories, but they're responding to the same macroeconomic backdrop. And Lori, when you take a look at this multifaceted backdrop that is not just one narrative, what gives you conviction that, frankly, the market is right, that the Fed is going to blink well before it raises rates to restrictive territory, which seems to be the zeitgeist right now in markets?
Well, the big conundrum, as we've talked about, and I've heard you talking about this morning as well, is that on the one hand, we still have inflation, which we could argue whether we've hit peak inflation or not, but the numbers are still quite eye-popping. We all know that eventually that wears itself out because the comps year over year get harder and harder. But that's happening at the same time that growth from a macro standpoint is slowing. And so this delicate balancing act is what the Fed's got to navigate, what all central bankers have to navigate. And everybody's afraid that they're going to get it wrong. And the chances are that they will get it wrong. We actually are a little bit more dovish in terms of what we think the Fed's going to do. And if they move in the summer and then actually do take a bit of a pause, then there's a chance that we get out of this without a recession.
Laurie, thank you for your perspective, as always. Laurie Heinel there of State Street Global Advisors. That is the consensus on the street right now. You can push back, agree with it, disagree with it, do what you want with it. But that is the consensus on the street right now. That near term, this is going to be messy. But long term, we get a relief rally year end. Because many people believe, Tom, like you, that we get to the end of the summer, the Fed reassesses and takes a step back from what it's doing.
Well, that's the catharsis story. It's a 32.27, John, in the VIX. Okay, there's a lot of agony out there. Maybe, John, things get worse. We get up to 38 or 40 VIX. My point is institutions adapt and adjust. I mean, John Stolf's coming up will tell you the same thing. These corporations, John, just like Kohl's, which has been a 20-year train wreck, Kohl's is going to adapt and adjust to what they've been handed.
The risk is when things like this happen, and we talk about this often, going back to the work of Soros, Popper, etc. Tom, you know it well. Markets can shape the events they anticipate. Deutsche Bank and Binky Charter talked about this, that some of this, Tom, can become self-fulfilling if financial conditions tighten too much.
No question about that. Bill Gross is actually very, very good about that over different cycles. You do get a circuitous nature, John, that you've got to be very aware of, and you particularly see that in bonds where price down is like, never have we seen this. And the answer is, as Lisa knows better than me, spreads are actually well contained.
Spreads just about starting to break out now. Though, Lisa, where are we at now? Pushing 500, 470, 480?
Yeah, to the highest levels going back to May of 2020 in the high yield space. How much does this start to get people's attention? Not so much quite yet, but it's starting. And this is really what perhaps the Fed will blink at. It's not going to be stocks.
It's on the radar. It's certainly on the radar. Futures down by 1.2% on the S&P. On the NASDAQ down by a little bit more. From New York City, this is Bloomberg Surveillance.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. China's top diplomat has again warned the U.S. about its increased support for Taiwan. In a phone call with National Security Advisor Jake Sullivan, Yang Jiechi said the U.S. is going down the wrong road and that could lead to a dangerous situation. Earlier this week, the top American naval officer said Taiwan must prepare itself against potential Chinese aggression through military deterrence. And there is a sign that Beijing is strengthening its energy ties with Moscow just as Europe turns towards banning imports. Bloomberg has learned that China wants to replenish its strategic oil stockpiles with cheap crude from Russia. The strategic reserves are tapped during times of emergencies or sudden disruptions. And the world's richest person saw his wealth shrink by more than $12 billion in one day. Tesla fell to the lowest level this year, knocking Elon Musk's fortune down below $210 billion. Musk has lost $49 billion since launching his bid for Twitter last month. Part of that is due to the wider market sell-off. Plus, investors in Tesla are concerned about how Musk will fund that Twitter bid. And President Joe Biden has invoked emergency powers under the Defense Production Act to try to boost production of baby formula. He's also ordered that government planes be used for imports. The baby formula shortage has emerged as the latest crisis for the White House. It's been months in the making and could ease soon when production restarts at a key plant. Gabe Plotkin is shutting down his $7.8 billion hedge fund, Melvin Capital Management. More than a year ago, the fund was grievously injured in a GameStop short squeeze by amateur traders who organized on Reddit. It never recovered. A comeback effort showed initial promise, but unraveled in recent weeks. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
we feel responsible for the capability of the Ukrainian state and its people to defend themselves. We see a number of double-digit billion euros which are needed for the foreseeable future of the next months.
The Europeans are in a tough spot right now, that's for sure. Christian Lindner, the German finance minister from New York City this morning. Good morning. This is Bloomberg Surveillance. The negative follow-through looks like this in the equity market. The S&P is down by more than 1%. The Nasdaq is down by 1.2%. Treasuries are rallying again. Yields are lower by 5 or 6 basis points. And there's the move on crude, Tom. 107.65 on WTI. We're down about 1.8%.
Yeah, I mean, there it is. And right now, Brent is fractionally pennies above where West Texas Intermediate is, but it's got its own gyration. And we're focused, as Lisa's mentioned, on the distillate market, which is what you do with the oil when you go through the refinery process. We're going to stagger forward here. Mark Champion joins us now in Glasgow, and also Jack Fitzpatrick in Washington. Mark, let me go to you. I was rude and spent way too much time with Fitzpatrick in Washington the last go around. Mark, I think that the grinding news of the war in the American press shows a new phase. Do you agree with that there's a new phase to this war, or are we just getting war exhaustion?
No, I think it is right. I mean, and it's a little different from, there have been several phases already, but those change as a matter of choice on largely the side of the Russians. So, you've had the very first phase, which was the initial invasion. It was going to be very quick and light-footed and all that. That clearly didn't work. So then they started a new strategy. That didn't work. So then they pulled back from Kiev and they moved to focus on the Donbass region. But what we have now, those were all, what we have now is that you can still call it a new phase in the sense that it's pretty clear now that we're in for a war of attrition that's going to take a long time, months or years rather than weeks. So if that's the case, it changes all calculations for everybody. Changes calculations about sanctions, about weapons provision, training, development of reserves, all that.
And also fiscal spending, Mark. And we are hearing about the potential alliance between a number of European allies to provide fiscal spending to Ukraine to rebuild, but also to spend on military, to spend on other initiatives. How much has this basically been an upending of the austerity of Europe and a move to greater fiscal spending that could come in the near term?
Yeah, I mean, we're talking about quite significant numbers. I mean, collectively, Europe obviously has deep pockets, but they are significant numbers. And I think the understanding now is, again, that, we're in for this for quite a long time. And that it's not only about the reconstruction of Ukraine when it's over. It's about how do you keep the country moving while the war continues, because it has to have a functioning economy. It has to have infrastructure that works, transport links that work. So all of that has to be done. So, yes, it is quite significant.
There's a lot going on, obviously, Jack, and this war in Ukraine only exacerbates issues that people are worried about with inflation, which is really dominating the headlines here in the United States and, frankly, the political landscape. How much is this administration focused, and how much is it basically, choose your own adventure depending on the day and lacking a narrative that really can get it to the midterms?
Lacking a narrative, I think, is a fair critique, and responding to crises, just one crisis after another. Some of that, if you want to try to criticize the White House's messaging, fair enough. Some of it may just be very bad luck. But yeah, that's a significant issue. You see it with Democrats in Congress, too, mentioning the inflation concerns, sort of a very piecemeal approach to trying to show the American public they're taking action in any way they can. Some of it is a bit clumsy. There's some Democratic pushback even to the Democrats' bill on price gouging and the attempts to sort of shift people's focus toward price gouging or corporate greed, as some Democrats are putting it. But the struggles are real to try to sort of focus the attention where they want it to go, rather than playing whack-a-mole and just trying to respond to daily crises.
Jack, for our international audience, summarize the election of 2 days ago. How did the center of both parties do?
The center, as traditionally described for the Democrats, did not do well. John Fetterman in the Pennsylvania Senate primary was sort of seen as the progressives pick and won over Connor Lamb, the moderate House member who had impressively won a House seat a couple years ago and flipped it. Fetterman won by more than 30 percentage points. Big win for the progressives. On the Republican side, we're probably going to end up seeing a recount. But it's a very narrow lead for former President Trump's pick in Mehmet Oz of Dr. Oz fame. If he holds on to the narrow lead, I guess you could say he's essentially the establishment pick if former President Trump is the establishment. But that's a very close one, so it's a little tough to say how that's going to pan out on the Republican side.
Hey, Jack, thank you. Jack Fitzpatrick there and Mark Champion on the latest worldwide in global politics. Futures right now off the lows, but still down about 1% on the Nasdaq and the S&P 500. One name to look at, Tesla. Dan Ives of Wedbush, big bull on this name, less bullish, says the following: the China headwinds are hard to ignore, still bullish, but lowers the price target from 1,400 to 1,000. Here's the quote, Tom. The success of the China story on both the supply and demand side are the linchpins to our long-term bull thesis in Tesla. That said, the reality is the current Shanghai lockdowns have been an epic disaster. The stock's down in the pre-market by 1.9%.
Yeah, John, bring up the board again. On radio, we're looking at 696.53 down 1.9%. John, I'm looking at like a 15-day chart of Musk, M-U-S-K as a symbol, also known as Tesla. And I'm sorry, John, this guy's in some real trouble.
This stock's rolled over,
I don't know the
Tom.
details. I don't get it.
Tom, you've joined the dots between what's happening here and what isn't happening with Twitter, haven't you? That's your view.
I'm just talking about basic like margin call dynamics, stuff we know, and there's always stuff you don't know. I'm just looking at a stock from 1,100 down to 709 right now. That's when you're doing margin and debt, bad things happen when that occurs.
This is a big move from early April, Tom, down about, what are we, Lisa? Down about 37% since the highs of early April.
And some people might say, well, this is partly just due to the shift in sentiment against some of the darlings of the pandemic era, which Tesla was one of them. Others would say maybe it's the flight of retail investors, although we haven't seen full capitulation, but more you have a loose cannon in the C-suite. And frankly, he seems to be playing around with different areas and dealing with certain disruptions in China and beyond. And how do you do that without necessarily some sort of focus and predictability?
It's been a tough market from the 52-week high. Just looking at the Bloomberg chart, we're down more than 40% for that single name. They're not alone. There are so many other names that have experienced the same kind of brutal beatdown in this equity market. Down 9/10 on the S&P 500 from New York City with Tom Keene, Lisa Abramowicz and Jonathan Ferro. For our audience worldwide, this is Bloomberg Surveillance. Live from New York City this morning. Good morning to you all on TV and radio. Here's your price action. Here's the good news. We're off session lows. Here's the bad news. Some negative follow through from an ugly session yesterday. We're down 0.75% on the S&P. We're down 0.8% on the Nasdaq. And Binky Charter over at Deutsche Bank does not think this is over yet. He points out that your average recessionary decline in the S&P 500 in the post-war period is 24%. With that in mind, he thinks the downside here is 36.50 in the near term on the S&P, and then we recover. And Tom, we're hearing this a lot on Wall Street at the moment. A near-term price target, more downside. Longer term, a relief rally. The reason for that, if you look over at the work at Goldman, is this belief that any rally you get in the equity market might be perceived by this Federal Reserve as an unwarranted loosening of financial conditions and something they should push back against. Now, that is the complete opposite of the last 10 years, Tom. That's a real regime shift for this equity market.
John, we're rationalizing the moment, and we're comfortable, and it's used to doing that in equities. John, we need to rationalize the bond market as well, and I don't really see that going on.
The push-pull, let's talk about it, Tom. The relationship, the traditional one between stocks and bonds, is back, for now, at least. And we can talk about that right now, with equities lower and the bond market doing this. Yields lower too. So that inverse relationship between equities and bonds is decent at the moment. Equities are lower, bonds are up, Treasury yields are heading south, Tom, on a 10-year, 283. And remember, 2 Mondays ago, 320.
Well, yeah, it's there, and if it breaks low, I mean, if you have a VIX to triangulate it to the VIX, John, a 31.91 right now, okay, that's stressful. I get it. What does yield do, John, if you pop a VIX to 38 or 40?
I would say this, Tom. What do yields do if equities start to rally again? What's driving what here? If equities start to rally again, do you get a move higher at the front end on a 2-year? Do you get a move higher in Treasury yields because people believe the Federal Reserve has to come in and do more, Tom? Because equity markets are up and spreads are tighter
again. Now you've
again.
put the politics into it. How does the Fed blink against a slowing nominal GDP and a slowing real GDP?
That's what needs to break, Tom.
Yeah,
That's what needs to break.
Then that will be the relationship that will break all this mathiness we're talking about.
It just isn't right now. And that's the problem you've got as an equity strategist. It's why we keep hearing the same thing. 3-month price target, 12-month price target. Near-term bearish, long-term relief rally, because everybody still thinks that this Federal Reserve will get to summer, reassess, that's the consensus view, and then start to take a step back.
Who's doing stocks? Do I have to participate?
Ramo's going to do that. You don't have to do that. Lisa's going to do some single names for you. Would you like to do that now?
Please,
we can do that now. This is one of my favourite developments in this programme. That I get to go cross-asset, and then Lisa gets to do some single names. Without a bearish tilt, obviously. Oh, look at that, Tom. Everything's negative. Everything's negative.
What else is going on? And
What a
honestly,
shock.
and if I'm too negative, we'll have Tom come up here and he'll do it as well, which will be fantastic. But John, you were talking about the broader picture. How much do these specific names really color what we're seeing? Target continuing the decline. The buy the dip, not so much in retail. Shares down 0.9% ahead of the open after yesterday's absolute carnage, down 25%. For the worst day for this stock going back to 1987. John, I know you've been picking up on this, the Dollar Tree stores and some of the other discounters that really cater to the lower income tiers. Also down 1.2%. But yesterday, John, it was incredible how much these were penalized. And I wonder if this is really going to be the epicenter right now of what we see going forward. I'm curious.
Things are super tough. The margin story for some of these names. And the fact they can't find the right balance. What I've struggled with, Lisa, over the last couple of days in retail is trying to understand where the C-suite has just got wrong-footed by the change in the macro environment in the last 18 months, or whether there's something we should be really concerned about right now. Are the airlines telling you the same thing that, say, Target is telling you right now? I would say no. The airlines are telling you consumer demand is really decent. Everyone wants to travel. There's no pushback. Prices are up. Is this a change in the price mix, the product mix, or is this a change in the consumer? Is the consumer getting weaker?
Or is it a confluence of a lot of things that creates a rather toxic brew for CEOs? Kohl's is a very specific story. I know that Tom has gotten into that about the management. Shares down more than 5% after it really was another margin story. Revenues came in actually better than people had expected, but the profits not so much. And this has been a huge issue. Tom,
do you have a second screen?
Yeah. Yeah, there's a second screen.
Oh, yes.
And I want to get to, hold on a second, and I'll whip through this really quickly so we can get our guest. But honestly, this is where the other toxic brew comes into play, the supply chain disruptions over in China. Cisco last night came out and basically said that any sales growth would be wiped out in the first quarter. Why? Not because of demand. Demand was just fine. It was because of what's going on with China and the lockdowns there. Cisco shares down nearly 12% ahead of the open after really reporting this. Again, this is not demand-driven. This is a supply-side constraint. Zoom, another one of those darlings from the system, the sort of tech issue, down also following yesterday's carnage in this shares, down 1.4% ahead of the open. And Amazon shares continuing their decline after a huge sell-off, down 0.8%. How do they right-size, Tom, given the fact they are overstaffed for the moment that we're in?
You killed that. It was the pendulum of toxic brew that I heard that was just absolutely
Only
superb.
one Lisa Abramowicz could come up with a pendulum of toxic brew.
Toxic brew. Lisa, pro tip. Okay, this is really important.
Yes.
I first learned this on the Bear Stearns equity floor. Okay, it's a little more complicated than yield up, price down.
Thank you.
Equities are a little more, Romain's delivered.
You try to say stocks are more complicated than bonds?
I think if you look at a 5-ratio DuPont series, there's some complexities there. It's just a different kind of mathematical dynamic than what you see in the fixed income.
Would you like to explain that to our next guest?
Hold on a second. John, is Tom trying to explain that things are complicated?
Let's go to Colin Martin right now before he hangs up. Colin Martin, of course, fixed income strategist at Schwab Center for Financial Research. Colin, you know what retail does is they look at their bond portfolio monthly. They're going to open the envelope, look at the computer screen, and go, what happened? How do they claw their way back with yield up, price down, big time?
Well, we do think it's going to be difficult for them to claw their way back, but you're right, Tom. That's the most common question we're getting, and it's not just the shock of seeing the price declines. It's what do we do now? And the unfortunate news we have to break to them is that we don't necessarily see a rebound in their bond mutual funds, because a lot of our clients are likely holding ETFs and mutual funds. And something that you all touched on before in terms of how much lower can yields go if we do get a risk-off environment, we just don't see that much room to go lower with inflation so high and the Fed likely to hike aggressively. So, unfortunately, we can't undo the past and the really poor performance we've seen this year. But the good news is that we do see a lot of opportunities out there, especially with higher quality investments. With yields up from treasuries and high quality corporates and munis, we're at yields that you haven't seen in years, highest levels of the post-financial crisis era. And of course, again, it doesn't undo what we've seen. It's not going to make the value of your bond funds suddenly get back up to the levels they were at the start of the year. But we do think it's an opportunity for investors who have been waiting for higher yields to put some of their funds to work.
All right, so where's the pain trade, Colin, especially as we look out at inflation that doesn't show signs of slowing, and we look at a Fed that is very concerned about this at a time when you have a complete reset of the globalization trends that really lowered inflation for so long. What is the pain trade for people who say bonds finally provide us income at a time when on a real level they're still not?
Well, yeah, it is very difficult. I mean, when you talk about a real level, that's the question we get. I mean, if you're looking at it, a 10-year Treasury yield below 3% when inflation's at 8%, a real yield of a -5 isn't very attractive. We do think tips are one way to address the inflation situation, especially with real yields moving into positive territory. If you look at tips with maturities of 7 years and beyond, you can actually earn positive yields for the first time really since the pandemic began. What we're focusing on with our clients is not to take additional risks. So when you talk about the pain trade, where we see more pain ahead is likely in the junkiest parts of the market, like high yield. Lisa, you were showing those headlines before about single names, especially in the retail sector. Coming into this year, we were concerned about corporate profits. Now, we don't look at single names. We look at it from a high-level standpoint. And what I look at specifically for the corporate bond market is data from the BEA, because that aggregates all corporate bond info, large, medium-sized, small, public, private, you name it. And corporate profit growth was really, really slow in the fourth quarter of last year. And we were concerned about how the beginning of this year would look. And unfortunately, it's not looking too good. And we're seeing, even these big companies that should be able to manage a lot of these issues, especially supply chain issues, still kind of stumbling. And that poses a risk for the junkiest parts of the market. If you're a triple C rated issuer, a single B rated issuer, you have those ratings for a reason. And you might not be able to handle any disruption to your operations, supply chain issues, volatile cash flows, things like that. So we think there can be more pain with junk bonds.
Colin, just quickly, just one point. And it's a question really for the equity guys. There's a lot of people coming on the program right now. I see it a lot in the research on the equity side, that you get to the end of the summer after a 3-month call, and then you get a relief rally because the Fed backs away. What do you think needs to happen for the Fed to back away from what it's determined to do at the moment?
I'll steal Powell's line and say that we need clear and convincing evidence that inflation is retreating. And we don't have that just yet. If you look at the CPI report for April, it did come down. It decelerated from the previous month, but still at very, very high levels. And there are a lot of things under the surface that indicate that inflation can still remain high. I mean, we're still seeing wages grow, and we're seeing a lot of prices paid indices from the various Fed service indexes, from the ISM indices, both manufacturing and services, that prices are still high. So if we get to the summer and inflation has only showed a modest retreat from the highs, that might not be enough for the Fed to slow down. And even when we talk about a slowdown, the Fed's not going to stop hiking rates. They might just revert to 25 basis points as opposed to 50. And if you look at what the Fed funds futures market is pricing in, despite all this volatility over the past 5 or 6 weeks, markets are still pricing in 2.7, 2.8 for Fed funds rate at the end of this year, despite all that.
And I know people who think it's going to go higher than that, Colin. as well. Colin, awesome. As always, buddy. Colin Martin of the Schwab Center for Financial Research. Thank you to everyone writing in. This from a Bloomberg subscriber. Take this man's tang away and put him in timeout. Stocks are not more complicated than bonds. You've upset some people this morning, TK. From New York City, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. President Biden meets today with the leaders of Finland and Sweden to discuss their bids to join NATO. Turkey's President Recep Tayyip Erdogan is opposed to the move because of the two countries' stance on Kurdish militants that he considers terrorists. Turkey called on NATO members to do more to address its security concerns. In London, police have wrapped up their high-profile Partygate investigation that already caught Prime Minister Boris Johnson. More than 126 fines have been issued over COVID rule-breaking parties held at Downing Street during lockdown. None of those fines were identified, but a spokesman says Johnson will not be fined a second time. Sri Lanka has fallen into default for the first time in its history. Policymakers had flagged to creditors that it wouldn't be able to make payments within the grace period. Sri Lanka's government has been struggling to halt an economic meltdown that has prompted mass protests and a political crisis. Authorities warn that inflation may hit 40%. Another U.S. retailer cutting its profit forecast. Kohl's has reduced its outlook for the full year. First quarter sales and profit missed estimates. Kohl's says it's reviewing strategic alternatives and continues to engage with what it calls multiple interested parties. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Stocks don't go up when inflation's running north of 4%. And just, so historically that's the case. So yeah, I think it's a tough, situation. And I don't think the market this year is going to put in a great year.
That was Andrew Sliman, the Senior Portfolio Manager of Morgan Stanley Investment Management. Your equity market looks like this. We're negative by 0.9% on the S&P. On the Nasdaq 100, down by about 1%. Euro dollar, just about positive, 105.23, up 0.6%. This will excite you. The ECB accounts out in the last 10 minutes.
Oh,
some
Lisa,
officials,
please weigh in here, Lisa.
Some officials, she loves this. Some officials wanted
minutes?
to act without undue delay. I don't know why they like to call them the accounts, but they do.
All right,
There's less detail, perhaps. I don't know. The outlook for the third quarter growth is still, quote, relatively positive. Do with that what you will. I don't know. Their account of the policy meeting reads as follows as well. One more headline, Lisa. Officials saw the war slowing, not derailing the recovery.
That's what I picked up on as well, at a time when more people are talking about recession in Europe and people use that as their base case. I mean, we talk about that in the U.S. So how much is this basically an ECB setting up for rate hikes and possibly getting to zero non-negative deposit rate by the end of the year? And that, I think, is what basically they're trying to confirm.
John, can Leicester City beat Chelsea today?
Is that your focus?
Yeah, that's my focus.
You're more excited about that than June 9th.
Can Leicester
meeting.
beat Chelsea today? What do you think?
They have a chance. Chelsea's not exactly playing well.
Okay, fine. Thank you.
That's your review.
Kriti Gupta's going, let's go. She's got a chart. Kriti, what do you have this morning to save us?
Well, if I can harp on what Lisa was just talking about, the recession odds in Europe, that seems to be the base case. Well, that's feeding into a lot of flows for the dollar. Of course, today you do see the dollar weaker, but I want to tie the dollar story to the stock story, which brings me to my chart of the day. The 40-day inverse correlation between the stock market and the dollar. Essentially, for our radio audience, what you're seeing is a sea of red. What it shows you is that during the pandemic, there's been this dynamic. A weaker dollar equals higher stocks and vice versa. And now, right now, of course, you have that correlation sitting at about a 0.4. Statistics nerds will say that is not significant. But if you look very closely, it tends to bounce back to a 0.7, which tells you that that is a very serious relationship, especially when it comes to capital flows. Do foreign investors, in the face of COVID lockdowns, in the face of those European recession odds, flock to the dollar and therefore flock to U.S. stocks? So keep an eye on this relationship.
Kriti, thank you. Greatly appreciate that this morning. This is a timely conversation with somebody that's covered all of American politics from his New Hampshire back decade and decade in this topsy-turvy world. Greg Valliere, AGF Investments, with us this morning. Greg, I want to go bigger, broader here. 3, 4, 5 years ago, if you and I were having a beverage of our choice about Ronald Klain, we would talk about a hugely respected, bright attorney, respected by Republicans and Democrats. He's driving the ship at the White House. What is Ron Klain and the Biden staff doing to provide a cohesive message for a president struggling?
Not a lot, Tom. Good to see you this morning. I think that there's a perception, fair or not, of the White House being in disarray. I think with a debacle shaping up in the November election, Biden has to do something. And he's not going to get much legislation out of Joe Manchin. So I think what Biden has to think of, it sounds harsh, but he has to think of a staff shakeup. And if there's a staff shakeup, Ron Klain would have a target.
I mean, Ron Klain would be a target, but if we say he's Panetta-like, all of us internationally, domestically, forgetting about the previous administration, whatever you think, are baffled by this White House. Help us with the next round of shakeup, if you will.
Well, I think they have to focus on not just personnel, they have to focus on policy. Will there be a decision finally on student loan relief? Will there be a last-ditch attempt to work with Manchin on some social programs? They need to show the public they can get something done. And with the exception of a pretty good unity within NATO, there's not much they can show.
So there's a lot of controversy over the spending that was done during the pandemic, particularly the stimulus checks that a lot of people look to as part of the driver of inflation right now. But other people are saying, especially heading into what could be a downturn, spending will be important, especially on some specific areas of infrastructure and defense. What are you seeing in terms of any consensus in D.C., given the disruption, the turmoil that you talk about, to get some of that done into the midterms, but really beyond?
Isn't it ironic, Lisa, that just when the economy starts to look like it's failing, just when you could use some fiscal stimulus or monetary stimulus, you get neither. And I think both fiscal and monetary policy will be contractionary. Frankly, I only see one area on fiscal policy where spending could go up by a lot, and that's defense. I think there's a consensus in Washington that we've got to do more on shipbuilding, on purchasing new jets, and maybe coming out of this weekend's meetings between Biden and Asian leaders, we get a commitment for even more on defense.
Yeah, how much is the focus completely going to be on Taiwan at these meetings?
A lot. I mean, there's 2 or 3 quickly things that they're going to focus on. Can we have South Korea get along more with Japan, new government in South Korea? Could we bring India on board? Washington's been disappointed by India. I think they'll try on that. But the main message is to send a signal to China. I don't think Xi is ready to go after Taiwan now. After what happened in Ukraine, with all the sanctions, I think we'll see a stalemate there. But you'll see a strong signal from Biden, largely because of anxiety over North Korea.
Greg, words or policy?
I'm sorry, John?
Are they going to use words or policy? What are they going to do?
More words. Yeah, more words than anything else. I think they want to show the flag. They want to let our allies in that part of the world know that we'll never do an Afghanistan again, that we are rock solid in our support. And I give Biden credit on what's happened in Ukraine, but he needs to send a signal because North Korea is very close to testing more missiles.
Well, Greg, they've sent a signal, haven't they? Look at what's happened with Ukraine. Won't the Chinese just look at what's happened with Ukraine and say, okay, we heard you, thanks. We're going to do what we want anyway.
Well, I do think that China has to worry. If they tried to pull what Russia did, they would face enormous world sanctions. They would not succeed militarily. So I think that would be a signal that has already been well received by Beijing.
Greg, important thoughts, as always, sir. Greg Valliere of AGF Investments. TK, you said it, and I don't know why we just can't say things out loud anymore. Because everyone's too scared
because
of being
this
accused
show
of
is a
political
toxic
bias.
brew.
Tom, you can say things out loud if they are true. The previous administration, it was chaotic. It was messy. You can say it. Yes, someone might accuse you of being a Democrat. They might accuse you of being a Republican. But if it's true, you can say it. It is objectively a fact. You can also say this, that if the previous administration was not there, you would say that this administration was the messiest administration, Tom, you had seen in a long, long time.
I will let the full Brit make that opinion and not me, because I'll get in the timeout chair. John, true story. And folks, we have this acclaimed Bloomberg information system called the message system, which basically is one part Twitter, one part email. John, I had one message come in from a wonderful fan once and said, you're to the left of Putin. To the right, the left of whatever, and the exact next message said I was to the right of Attila the Hun.
Tom, how many guests have you heard in the last 12 months say Ron Klain's got a target on him? And Ron Klain's still there.
True.
How many
Big
times have we
time
heard
true.
that? I've heard that so many times in the last year. Futures down 0.8 on the S&P, on the Nasdaq 100 down 0.8% also. From New York City, this is Bloomberg.
It could be a situation where the consumer is saying, no more inflation. I'm not going to pay the higher prices.
Their ability to spend on things besides those true staples has been diminished.
We are looking for peak, at least in headline inflation.
It's going to be harder to get that soft-ish landing.
I would say recessions are pretty likely in 2023 in lots of places. I think it's just plain blind luck if we can avoid them.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, I think, everybody. Bloomberg Surveillance, Jonathan Ferro, Lisa Abramowicz, and Tom Keene. It's a toxic brew out there with a market in modest recovery from where we were 2 hours ago. John, everyone recalibrating.
That's the good news, Tom, that we're off the lows. The bad news, we're down 0.75% after the biggest daily drop going all the way back to summer 2020. They weren't good times. TK, everybody is reassessing, but they're reassessing in a very, very peculiar way. They're reassessing in the short term, but not in the long term. And I keep seeing that on the south side, Tom, in the equity market. In the short term, very cautious, high cash, looking for more downside. In the long term, looking for a relief rally. Why? Because you've said it a million times this morning. There is a belief out there that if things get tough, things get bad in this market, that this Fed will step back.
Well, that's the bet right now. We have a really confirmed bull coming up, folks. This is must watch, must listen. Bloomberg Radio TV. John Stolfus with us in a moment. John, I want to go to something we haven't talked about in the last 2 hours because I know people are glued to this, and that is the real yield coming back within the vicinity of zero. What a shock if we return to a negative real 10-year yield.
Yeah, and that's been a change as well, Tom. We were looking at a one-way road towards higher real yields,
well said.
And then we've backed off because largely, Tom, the shock has changed. If you think about it in a three-step routine here, we've gone from an inflation shock to a Fed shock, a big pivot, a rate shock, and now we're talking about a growth scare. That third piece, Tom, is what we've started to price a whole lot more recently.
John, is it the same in London, in the city?
In terms of what, Tom? The cautiousness?
The cautiousness.
Without a doubt.
The
Even
sweat.
more so, I would say.
Why?
Because they're conditioned by what is happening in the UK right now. You're always conditioned by your surroundings. In the UK, high inflation, upside risk to inflation, downside risk to growth. You look across the border, across the channel to Europe, they're facing recession. That's the early part of the story. And I'll say this as well for the UK and Europe, Tom. The difference between the UK and Europe right now is that in the US, people believe that peak inflation is in our past. In the UK and Europe, they think that number is still in their future.
Road trip, Lisa. We got to go to the Toxic Brew Company, Dayton, Ohio, 45402. Lisa, you said it. It's a toxic brew that captures perfectly the emotion that's out there. What are you focused on?
Right now, this idea of the market basically looking at stagflation, right? They're basically talking about inflation that's going to be persistently high and growth that's coming down. And they think that the Fed is going to start backing away. That seems to be the consensus baked into the idea that two-year yields are coming in. They're actually coming down even after Fed Chair Jay Powell said we will do what it takes to bring down inflation. So how does this translate over the longer term? Is this basically people expecting that inflation will roll over sooner as a result of demand drop-off, Tom? And if that's the case, what else do we have to price in terms of some sort of downturn?
Let's go to Brahma 101 right now. What do you see in credit spreads? I mean, I get the tension there. I get the reason the pros are watching. The difference in whatever the yields are in the discussion, Lisa, why does it matter right now?
Tom. Carnival. It's all Lisa wants to talk about.
Let's talk about Carnival. So basically, the cruise line operator yesterday sold debt at 10.5% yields. This is big. They sold debt 7 months ago at 6% coupons. This is 8-year debt. And this morning, it's selling down, right, in the trades, early trades. Basically, people are now demanding even more yield. Why would a company come to market to actually raise debt, number one? But number two, what does this say about when companies actually have to raise money, of how much higher those financing costs are going to be?
We got to stop the show. Should we do a cruise? Can you see the three of us?
I don't think we should do a cruise.
February?
I do think we should pick up on two really important points that Lisa just made, Tom.
Good segue.
No, out of Jacksonville, John, we can do a cruise and give lectures.
Evidently
you can
not
wear
so much.
Speedo. I'll wear,
John,
something appropriate.
I'll interview you, Lisa.
We can do a cruise to the Caribbean.
You've made 2 points here. Is there a problem with the company? One. And two, is there a problem in broader markets right now? I think there's always a difference between the price adjustment in credit and then you start to worry about whether a company can actually come to market or not and raise capital. They came to market, they had to offer up a whole lot more yield, and then you're saying the performance in the secondary market, the new issues, is poor. It's weak this morning. So let's make 2 points here. First, tell me about what you think this means for the company, the fact that they came to the market in conditions like this. And two, tell me what your response is to how we're performing in this new issue market off the back of what got issued yesterday.
Well, we can string it throughout the entire show, but basically it seems like there are a lot of mysteries to be unpacked, but this new issue market is not friendly right now to companies that need to borrow.
Everybody's making it up as I go is my subtle analysis. John, I'm looking one number on the screen, safe haven switch. As of yesterday, we saw strong Swiss franc, not a big deal, but it's a little tea leaf of the sweat that's out there.
Yield's in a bit as well. We're down 4 basis points on a 10-year to 284 right now on a 10-year yield. And just to wrap things up, futures down 9 cents, Tom, on the S&P.
Our conversation of the day as we talked to Patrick Pelfrey of Credit Suisse earlier. John Stolfus joins us with Oppenheimer & Company, their asset management chief investment strategist. John, thrilled and honored to have you on today. You will rationalize this to retail and institutional. How do you have courage to own equities this morning?
Well, Tom, thanks for having me on the show. Got to say where we are right now is the market's all kinds of in a tither because what's happening really is we're moving from free money to money that is less free, is essentially perhaps easy money, a long way from what a lot of people are thinking here. And I think that the danger is negative projection, taking anything that's crossing the tape here that's worrisome and projecting that that will stick. The big call here is just wait until, regrettably, we have to wait a little bit to see if what the Fed is doing is the right thing. And if that shows that inflation goes into check, things will get a lot better, we would expect.
John, the fabric of OPCO, and this is the legendary Myron Picone insurance securities analysis, is details. What is your experience of how corporations will adapt and adjust to this new 2022?
Well, I can't help but think of that cruise line that we just heard of.
You want to go on the cruise too?
Well, no, I don't know if I want to go on the cruise, but I can tell you this. I'd love to see the features on the covenant of that bond. You can just imagine when it's callable. It's probably very flexible. They're paying a ton of money right now in terms of the coupon, but I'm willing to bet you that if things get better, that bond will get called pretty quick. That's not with seeing. I have no idea what the covenant looks like, but you just got to figure they're going to protect themselves, and their bankers got to protect them, and with reason. The only difference, I think, where we're going is bond issuers are going to begin paying for the privilege of borrowing money, and lenders are going to, or bond buyers are going to get paid commensurate to some extent anyway, at least to the risk that they take on just normally when they buy a bond. And that's a healthier environment than free money, which we've been living in since the pandemic in April 2020.
John, you said a couple of things that are concerning, a ton of ifs, and then you said their banker will protect them. I'm not sure that brings a lot of comfort to many people this morning, John, because I've heard a lot of people saying this year to stay long equities, and we're down hard, really aggressively so. And now, John, the new line on Wall Street that I'm hearing is that in the next 3 months, things improve after that period because this Fed has to back away. John, the end of the summer feels like a lifetime away for people who have lost about 30% this year, and maybe even more so in single names and crypto. What are they meant to do in the next 3 months?
Well, John, you're pointing out the most aggressive stances. I mean, likely traders it's greed and fear and a lot of leverage for intermediate to longer term investors, when they look out, this is likely, in hindsight, to become a bump in the road. Usually when the Fed is in the process of either taking away liquidity or adding liquidity, right away, the smartest guys in the room always say the Fed is going to fail, Fed is pushing on a string, and then the Fed does its thing. Sometimes it makes mistakes on the way, but generally it has pivoted successfully to either bring the economy back in line with much more reasonable rates in terms of coupons, or it becomes more accommodative. It all depends. And, I've been doing this for 39 years, and my gut is telling me right now, this looks a lot like 09, early 09, before things straightened out. It looks like 1994. It looks like the fourth quarter of 2018. And these things, if you projected negatively on that point, you missed the rally that followed thereafter, things were basically right-sized.
I hear you, John. I hear you. John Stolfus there on the latest. And just to point something out, it's not the most extreme view. This is the consensus view on the street right now.
Yes.
Not my view. Here's the data. The median forecast on the S&P 500 year-end is 4,800. It's 4,800. Tom, just look at the market where we are. This street is still very bullish going into year-end. The only thing that's changed is that near-term, on a 3-month basis, they believe there's more downside risk. On a median basis, base case consensus view, the Wall Street is still very bullish.
They will recalibrate here, particularly with the calendar of into May, into June, and I would suggest 4,800 will come in. I would look far more, John, at expense, mergers, transactions, combinations. What are corporations going to do to move forward? For them, these are huge adjustments.
And Lisa, I'm not here to say that median view is going to be wrong. I'm just here to point out that it is very, very detached from what's happening now and over the last 5 months.
And how much of it is completely dependent on the Fed blinking, on the Fed coming in and saying, actually, we're not going to go quite as far. We're not going to have to do as much because inflation is starting to ease. How much is that baked into a lot of the valuations and assumptions in those bullish views?
Futures down 9/10 on the S&P. On the Nasdaq, we're down about 1 full percentage point. From New York City on radio and TV, this is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. China's top diplomat has again warned the U.S. about its increased support for Taiwan. In a phone call with National Security Advisor Jake Sullivan, Yang Jiechi said the U.S. is going down the wrong road and that could lead to a dangerous situation. Earlier this week, the top American naval officer said Taiwan must prepare itself against potential Chinese aggression through military deterrence. There is a sign that Beijing is strengthening its energy ties with Moscow just as Europe turned towards banning imports. Bloomberg has learned that China wants to replenish its strategic oil stockpiles with cheap crude from Russia. The strategic reserves are tapped during times of emergencies or sudden disruptions. And President Joe Biden has invoked emergency powers under the Defense Production Act to try to boost production of baby formula. He's also ordered that government planes be used for imports. The baby formula shortage has emerged as the latest crisis for the White House. It's been months in the making and could ease soon when production restarts at a key plant. Another U.S. retailer cutting its profit forecast. Kohl's has reduced its outlook for the full year. First quarter sales and profit missed estimates. Kohl's says it's reviewing strategic alternatives and continues to engage with what it calls multiple interested parties. Spirit Airline has rejected JetBlue's latest $3.3 billion takeover offer that sets the stage for possibly contentious vote by shareholders. Their choices either to back JetBlue or stand by a pending combination with rival deep discounter Frontier Airlines. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
I would say recessions are pretty likely in 2023 in lots of places. I think it's just plain blind luck if we can avoid them with the number of pressures coming to the system. But Europe is right in the firing line.
I don't think strategists should be able to come on and make a call the day after their team lost. That was Kit Jukes of SocGen the day after Arsenal lost, and he was so gloomy and bearish, Tom.
He was.
Do you think there should be a regulation against that? If your team lost the day before, you just don't get to come on.
Yeah, I think there should be a surveillance rule on that. I agree.
You have to let him respond to that.
It was
Come
painful.
on.
Futures down about 1% on the S&P. On the Nasdaq, we're down about 1 full percentage point. Just bear in mind that AC Milan has a title-winning game this Sunday, and I'm not at work Monday. Okay, just remember that.
Very good.
So,
very
I'm
good.
just abiding by my own rules.
Well, that's very good.
Okay.
You know, Milan can be good. I like some of the food at the train station there.
Thank you, Tom.
It's very good.
Thank you for weighing in.
Let's move on right now, and we are guilty of this, and I am incredibly guilty of this. We look at, well, the joke of me going below 59th Street, or the idea that most of our audience is in 3 zip codes and a couple in London as well. And we forget about the open plains. Mike Rounds knows where the Missouri River is. He knows that getting from Pierre, South Dakota, over to the Target store up I-29 north of Sioux Falls is actually something difficult to do. Ever more so at $5 a gallon gasoline. The senator from South Dakota, their former governor, joins us this morning. I want you to give me a visceral picture, real estate guy, of the emotion in Pierre and the emotion at that Target store north of Sioux Falls. What's going on out there away from the fancy people like Global Wall Street?
I know you like dollars and cents. The average South Dakota family right now is paying over $604 more per month in living expenses than what they were in January of 2021. That's $7,000 plus per year more, and wages aren't going up that fast. When you start talking about that in places like South Dakota, the pain is real. And it's the same thing across the entire country. And the worst part about this whole thing is this is policy induced. When you start driving up the price of fuels, diesel, natural gas, and so forth, by policy determination, and you start limiting the amounts of supplies that are being produced, and you recognize that you're doing it, and you do it anyway, then it's a policy-induced movement. We can do a lot to change that right now in the United States, and it's got to come back down to an administration recognizing that, look, I know they're fighting climate change, but the bottom line is you've got to have a strong economy to do a good job on that. And they are hurting this economy with their policies. And people in South Dakota feel that, and they're not happy about it.
Senator Rounds, Gerald Ford of the Republican Grand Rapids, Michigan persuasion years ago said he was going to whip inflation now. What is the Republican prescription day one to stop this inflation?
There are 3 parts to the policy. One is demand. You can do that through action at the Federal Reserve, but it's because we put a huge amount of cash into the economy earlier. And that was a Biden decision, and he did it without the assistance of Republicans in January of last year. Number 2, you have to reduce the cost of energy, and that means you produce more energy, all of the above. Whether it be nuclear, whether it be more pumping, it means more leases being released, and then allowing them to get that crude oil out of the ground with additional licenses, and then allow them to be able to actually move that to the marketplace with pipelines. That would be an immediate thing. And finally, you have to address the workforce issues. Right now, and I know that this isn't a popular thing to talk about, but we have to have legal immigration reform. We need visas, we need H-2B visas, we need H-2A visas right now. And we've got legislation in place right now that we're recommending that would do that. All of those would help to reduce inflation in this country, and the effects would be immediate.
Well, Senator, just to push back a little bit, you're talking about the issues with certain policy prescriptions that led to the inflation. But a lot of economists say is driven by some of the supply disruptions, whether it's in China or particularly the war in Ukraine. How much do you see as inflation staying high as a result of certain national security decisions being made that you've supported?
Yeah, first of all, I think the actual inflationary trends with regard to the supply chains and so forth, a lot of that has to do with the cost of transportation of those items. Now, can you have supply disruptions? We had it. We had it during the previous administration, but you did not see that driving up inflation. You saw inflation begin almost immediately upon the recognition that we were going to have increases in the cost of energy within this country, and they were going to be increased by policy determination. Once again, If you take back and you look at the actual costs of energy and the impact that that has on all types of pricing for services and for products, it's a no-brainer that you can begin to reduce inflation if you address the cost of energy. It's in all of those products.
Aside from just the energy issue, though, I'm wondering, Senator, would you agree with potentially relaxing certain tariffs on China or perhaps changing certain stances in order to reduce inflation domestically, even if on a national security level it was viewed to be prudent to keep certain things in place?
I think that there is always the possibility of looking at modifying policy with regard to needed items. But remember, there's a reason why we put those in place in the first place, and that was to try to develop domestic production. But if you can't do it domestically and you've tried it, then to look at other alternatives with other countries. It's not that we want to produce everything in the United States. We'd love to have good trading partners. But we also have to recognize that simply going back to China does not fit into the long-term scheme. And as long as they're going to try to continue to steal the IP in this country, we've got to continue to recognize the need for enforcement of trade deals and the limitation of trade with China whenever possible until they come around and recognize that they can't be stealing the IP, the copyrights and so forth. So, yeah, look, I'd be very stingy about going back on what we've already done with China. I'd try to develop some of those product lines with our other allies and other people that literally want to do business with us under the rule of law.
Senator, thanks for your time today. We appreciate it. Senator Mike Rance there on the story at D.C. and worldwide. And Tom, there are only a couple of things that I think you can find that Democrats and Republicans agree on at the moment. One of them is China, and has been now for a number of years.
And on this Indo-Pacific trip, that trip for the president, that is absolutely the immovable force. And quite frankly, whatever happens 2 years from now, John, why is that going to change? I don't suggest it would change.
A difficulty for this administration, and the previous one for that matter too, Lisa, is how do you reconcile your domestic economic problems, your goals here, with your foreign policy objectives as well? China front and centre, Russia too, for that matter as well.
And Europe has that problem much more, frankly, than the U.S. right now because of trying to wean themselves from their dependence on Russia for gas and oil. But in the U.S., how much is it going to increasingly be a calculation? How much do you keep a firm line when it is causing prices to go up? And frankly, you're on a 4-year election cycle. Honestly, John, this has been one big issue.
It continues to be a monster issue. Futures are down about 1% on the S&P, on the Nasdaq 100 down by 1.14%. Yields are a little bit lower. We're down 6 or 7 basis points to 281.90, and crude is down a little more than 2% at $107 a barrel on WTI. From New York City, for our audience worldwide, this is Bloomberg Surveillance. Some economic data in America just moments away. Futures are negative by about 1% on the S&P. On the Nasdaq 100, down by a little bit more so. Yields are lower by 6 or 7 basis points on a 10-year to 281.90. Waiting for some jobless claims in America as we wait for that data to drop. Here's Mike McKee. Morning, Mike.
Good morning, John. 218,000, so a slight rise in the number of people filing for first-time unemployment claims. 203,000 was the unrevised number last week, waiting for that revised number to come in. The other number that we want to keep an eye on here is the Philadelphia Fed, because remember the Empire Index collapsed last week, or earlier this week, I guess it was. The Philly Fed Manufacturing Index comes in at 2.6, it looks like, which is significantly lower than 17.6, so which was the April number. So it looks like a slowdown there. New orders, though, rise in the Philly index. The other one that we want to see is prices paid fall, 78.9 versus 84.6. So mixed numbers out of the Philadelphia manufacturing. Not sure what that tells us about the progress of the economy. But jobless claims tick up just a little bit. They're still within a range. Doesn't suggest that the labor market's falling apart, but maybe we're starting to see people hire a little bit more slowly.
Just a really small shift in the market, Mike, and thanks for that. Equities are lower by 1.15% on the S&P, basically the same on the Nasdaq 100 too. See a little bit of a shift. I put the emphasis on a little bit in the bond market. Yields come in an extra basis point on a 10-year to about 281. A 30-year, a break of 3% TK. We're down about 7 basis points on the day.
Yeah, it's important. 30-year bond under 3%. Now we'll have to watch that carefully, see how it plays off of this data. Mike McKee, I've got to ask you about the gentleman from Carnegie Mellon. What was the major distinction yesterday with Charles Evans? What did he say that got your attention?
Well, I think he has gone from we don't need as much at the beginning of April to now we may need to go above neutral to slow down the economy. That's probably the takeaway from him at this point as far as the markets are concerned. But you know that something very interesting has happened. The markets have moved the yield curve above what the Fed officials are saying is the neutral rate. So forward guidance is making a big difference in the economy right now compared to interest rates. We're already priced for neutral or above. So maybe we see the economy slow a little bit more quickly than people on Wall Street are fearing. And that raises the question, does the Fed go too far, too fast? But it could also mean maybe they have to do less in the long run.
Mike McKee, thank you. Tom, I think that raises the big question right now. It is so difficult to strike the right balance in this economy, whether you're in the C-suite or in the central bank.
We're all making it up as we go. There's just no other way to put it. Down negative 363, SPX negative 46. The VIX was a 33. I'm going to call it fractionally improved in the tumult, 32.15. Well-timed, Stephen Stanley, Amherst Pierpont, who is brilliant at forecasting. Steve, I got to go to your wheelhouse. Have you changed your forecasts in the last 48 hours?
Well, I guess the one thing that has changed a little bit this week is the retail sales numbers for April were quite a bit stronger than expected. So it does look like the consumer retains a lot of momentum. And obviously, as long as that's the case, the economy should be in good shape, at least in the near term.
When you look at Fed policy and the idea of the Bloomberg Financial Conditions Index tightening, what Michael McKee just said about terminal value dynamics, is this a Fed that will change its tune before the June meeting?
No, I think they are very much focused on inflation until they see convincing evidence that inflation is coming down towards something that they can find acceptable. They're gonna plow ahead. And I think Chairman Powell wanted to take away a lot of the near-term volatility. Chairman Powell and the whole FOMC, it seems like, by announcing that they're likely to go 50 in June and July. I think that's pretty much baked in the cake, and then we'll see what happens once we get into toward the end of the summer and into the fall.
This is exactly why I find it fascinating that some of the turmoil that we're seeing in equities and other risk assets are really translating into a bid for bonds, even on the short end, even on the 2-year yield. Do you think that this is misplaced in terms of what people's confidence is that the Fed will actually step back a little bit from an aggressive plan in the face of stagflation?
Well, I think financial markets have a really tough time discounting things that are likely to happen or may happen in the distant future. So we have this tug of war right now between a strong economy and very firm inflation in the short term versus the possibility that the Fed's going to end up tightening so much that we get a recession somewhere down the road. And the debate really is about the time frame of that and the likelihood of that. And I think the markets are just having a hard time with that. The markets want to look forward, and they want to, if something's going to happen 2 years from now, they want to price it in today. And it makes it very tough. I think personally, I think the fears about recession are a little bit overblown, not in the sense that we're certainly not going to get a recession. I think that a recession is at least a 50-50 bet, given how far the Fed's likely to go. It's just that the timing is pretty far down the road. I think we're talking about 2024, maybe later. And again, I think the markets just have a really tough time trying to properly discount something like that that's so far down the road.
And you say something, how far the Fed is going to go, how far they are willing to go. And right now it seems like people are bringing that back. Actually, even as Fed Chair Jay Powell says, we may have to move to a restrictive stance, and other Fed members say the same thing. The market is saying, nah, not really. You'll get to neutral and then you'll reassess. Do you think that this is also wrong, that perhaps the terminal rate is closer to 3.5% for the Fed funds rate rather than 2.5 or 3?
Yeah, I do. I think the Fed's going to have to work pretty hard to get inflation down. I think we've had high inflation long enough that people are starting to get used to it, which means it's going to be harder to snuff out. And this has been a big focus of mine for a long time. I think the markets are not pricing in a high enough terminal rate. I think we're likely to see something closer to 4 than to 3 at the peak of the cycle. And that's why I think that there's a really good chance that the economy is going to slow down 18 months, 24 months from now. But in the meantime, I think there's a lot of momentum, and I do think that inflation is going to continue to be a problem for certainly for the near term.
What does nominal GDP do, Steve Stanley?
Well, in the near term, it's going to be high. I think real growth this year is going to be in the neighborhood of 3%, and prices obviously are rising very fast. So nominal GDP is going to be in the high single digits this year, and probably still in the mid to high single digits next year. So well above what is sustainable in the long term. And again, that's why the Fed is having to do what it's in the process of doing.
Stephen, we are looking at a market that is searching for a narrative and struggling to coalesce around one. Right now, the dominant narrative is that you are seeing a deceleration in spending. You're seeing a consumer pull back. And you're seeing companies with margin squeezes that we've been waiting for and are finally starting to read in the data. How much, the data, I should say, how much are you looking forward and seeing this as the predominant narrative in the months ahead?
Well, I think the consumer still has a lot of momentum. You look at the numbers on the household balance sheet, and households are sitting on trillions of dollars of extra savings that they accumulated during the pandemic. And now that the economy should be pretty much fully reopened, I think we're going to see a bit of a feeding frenzy in the late spring and into the summer in terms of travel and going out, whether it be to restaurants or to ball games or to shows or whatever the case may be. I think we're going to get really strong consumer spending over the next, call it 3 to 6 months. Beyond that, we'll have to see. But I do think that the economy retains considerable momentum in the short term. And I would just, one comment I would make, I thought it was interesting that the takeaway I had as an economist from the Walmart and Target results, which, it seemed like the predominant narrative around that was that the consumer is slowing. But basically what I heard is demand is still strong, but profit margins shrunk because they underestimated how much their costs had gone up. And unfortunately, that means that going forward, the next step should probably be more price hikes to recover those lost profit margins. So we'll see. At some point, there's a tension between that and consumers' willingness to pay, and maybe we're getting to the edge of that for certain products. Certainly housing, it seems like people are starting to balk at high home prices, and we'll see that, I think, more broadly across the board at some point, hopefully. But there's a big tension there in the short term, and I think it'll be an interesting dynamic over the next several quarters.
Stephen, great to get your views as always. Stephen Stanley of Amherst Pierpont. Lisa, just on that final point there, does it resolve itself in a favourable way for this economy, for this market? And for a lot of people, the bias is so obvious, it's kind of lose-lose at the moment, because if they can pass it on to this consumer, that means prices are up and the Fed does more. And if they can't, people will be worried about a downturn.
I completely agree. So it is lose-lose, but the nature of the loss in markets is going to be different, right? And this is where, again, the bond market reaction is fascinating, because it's taking the negative side of that, basically saying this means they cannot pass along the prices to consumers, to Stephen's point. What if it's the other way around? What if this is just a precursor to more price hikes? And if that gets passed along just fine, because frankly, the appetite to spend is there.
That's the bearish bias at the moment. Do you remember retail sales? It was only 2 days ago. Tom, no one talks about the retail sales data point at all. It was only 2 days ago.
Stephen Stanley started with that. And, again, this is a central bank that is data dependent. I would suggest the market is doing a lot of the heavy lifting for Jerome Powell.
Isn't that your drinking game, data dependent?
Yeah, it is a data. Yeah, it is. Well, the Tang is here, and
any excuse, right?
It's Polish now. Okay, good.
Sure, good. Enjoy.
John, we've had a huge response to the thinking of a cruise, and I need your advice, John. Do we do like a Miami to Barbados thing, sort of easy for people to get to, or do we really go large and do more out of Athens? I mean, where you go circular
you're going to have
back
to confirm
to
how much you're going to pay me to get on this ship, because I'm never going on a
John,
cruise.
Ever. The speaking fees are stunning.
Can I just tell you, so this is the way the conversation goes. Tom's saying, we're going on a cruise. John says, no, we're not. I'm never going to go on that. And Tom says, where are we going to go? Let's discuss. And John says, no, not going to do this.
No.
This is the morning. This is
I've
Bloomberg
been going
Surveillance.
back and forth with Cruise Critic. They're really, really wonderful.
Just cruise.
February 2023. I mean, John, it's doable. Miami to Barbados.
The reason I do this, Tom, is because in about 2 minutes I get to walk away. The idea of being stuck on a ship with you.
Oh no, no.
That's tough.
We have our separate houses.
That's tough. Futures down 1.2. on the S&P.
I have floaties, so I can swim.
And you told us about your choice Speedos too.
I got that right.
Hard pass on that from New York. This is Bloomberg.
No pun intended.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. President Biden meets today with the leaders of Finland and Sweden to discuss their bids to join NATO. Turkey's President Recep Tayyip Erdogan is opposed to the move because of the two countries' stance on Kurdish militants he considers terrorists. Turkey called on NATO members to do more to address its security concerns. In London, police have wrapped up their high-profile Partygate investigation that already caught Prime Minister Boris Johnson. More than 126 fines have been issued over COVID rule-breaking parties held at Downing Street during lockdown. None of those fined were identified. A spokesman says Johnson will not be fined another time. Sri Lanka has fallen into default for the first time in its history. Policymakers had flagged to creditors that it wouldn't be able to make payments with the grace period. Sri Lanka's government has been struggling to halt an economic meltdown that has prompted mass protests and political crisis. Authorities warn that inflation may hit 40%. And McDonald's didn't have to look far to find a buyer for its operations in Russia. The existing licensee has agreed to buy the entire portfolio and operate the restaurants under a new brand. Earlier this week, McDonald's became the latest company to announce it would pull out of Russia in the wake of the invasion of Ukraine. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
There's clearly elevated risk for things going into recession. And then inflation, it's high. We have it coming down over the forecast period, but it's not going to be low. It's not going to be back to the 2% target anytime soon.
Seth Carpenter, Morgan Stanley, really good to speak to him yesterday. We are all recalibrating here this morning. Negative 400 on Dow futures have modestly improved to a negative 327 now. SPX negative 41. The VIX was out two big figures. A little bit of improvement there. But Lisa, very quickly here, yields have come in with some of the economic data this morning.
People are pricing in a slowdown increasingly, and you're seeing that finally with the bonds getting a bid. I do wonder, though, how much this is baking in the determination of a Federal Reserve to curb inflation, to get it under control, Tom.
That will be part of the parlor debate here. We're going to continue it forward and welcome all of you on radio or television. This should be a 3-hour discussion. His ability in our international relations linked to our economy is formidable with his work at Goldman Sachs International for years. Robert Hormats joins us now, a Taiwan advisor and, of course, a service to the nation in the State Department. Ambassador Hormats, I want to cut to the chase right now. I am hearing in every interview we will see a defense build-out by Germany. We will see a defense build-out by the United States of America. The president waltzes off to the Pacific Rim. What do we need to rebuild in the Pacific to show the flag in an appropriate manner?
Well, two things. One, I'm glad he's doing this now because I think there was a feeling in the Pacific, in some countries at least, that we were so preoccupied with Ukraine and Europe that we had more or less forgotten about the Pacific. This trip will demonstrate that we have not forgotten and that we realize that it's important. Second, he's got to get this set of alliances organized. There's been a lot of talk about cooperation, coordination, but there really hasn't been much progress on trade. The cooperation between the United States, Japan, Australia, New Zealand are all of these are important. And he has got to demonstrate that this is a sustainable alliance.
Right.
Pulling out of TPP was one of the worst possible things we could have done because it showed not only a trade set of actions that was pulling back, but it showed that we really were not committed to a sustained relationship.
Ambassador, I want to get through this quickly because Lisa's got some really important questions away from this. This is your wheelhouse. all Republicans and Democrats are against TPP. My guess is they're against Indo-Pacific. Let's go granular to the reported victory of Marcos Jr. in the Philippines and what we do at Subic Bay and at Clark. How do we shift our modern behavior back to what you and I knew in our youth?
This is a critically important point. The way to look at Asia is there are two island chains. One is the one that's very close to China. The Chinese really have increased their domination over that with their small islands and their new Air Force bases that they put in. We have to demonstrate that we have credibility in that so-called second island chain, which is the Philippines, which is the Marianas, Guam, and Australia, New Zealand. We have to show that we are a strong presence there. And working with the Philippines, which is critically important, it was in World War II, it is now, and that's going to be, I think, extremely important to demonstrate that we can work with young Marcos and develop our base structure, which was, as you know, virtually eliminated.
Bob, how optimistic are you that the political noise will be able to dovetail the national security issues of shifting around some trade partnerships at a time when inflation is very much at the forefront and people are more concerned about how quickly prices are rising as a result, in part at least, for some of the supply chain disruptions and realignments?
A very good point. I mean, the president's in a difficult spot. On one hand, it is clear that a lot of the tariffs that we've imposed on China do contribute. They're not the main contributing factor, but they do contribute to higher prices in the United States. And yet, if the president were to appear to be weak on that, it would look like he was weak on China. The priority here, it seems to me, is to deal with the inflationary issues. We can demonstrate that we're still resolute on China by strengthening our alliances in the region, which gives the president more flexibility to lower some of the tariffs on China, which really have not had any impact on China anyway, but certainly have had an impact on prices in certain sectors in the United States. So if he's tough enough and firm enough in building our alliances, it gives him a little more wiggle room to take action to reduce tariffs on certain Chinese items. And he needs to develop these trade relationships that we threw away when we got out of TPP. He's got to resurrect those and make sure that we don't just talk about them, that we have a firm and sustained program of trade cooperation with these countries in the Indo-Pacific.
Bob, just real quick here, we just have a little bit of time left. What grade would you give this administration in terms of reaffirming some of these alliances?
I give them very high marks. I think the fact the president now, in the middle of what's going on in Europe, is making a major trip to Asia is going to be very important. There's going to be a G20 meeting coming up. Whether he goes is not clear, but I think that anything he can do to demonstrate with these friends and allies in the region that we're back and credible is important. The one thing he also has to do is make sure that he can get bipartisan support for sustaining this, because a lot of these countries say, well, Biden's going out there doing this, making this good trip, but if the House flips and if you get another administration a couple of years from now, that could pull back from our commitment to alliances in the region. So we have to show, A, not only that we're doing this and we're firm in doing it, but B, this is a sustainable proposition.
Robert Hormels.
And C, we've got to figure out how to deal with the Chinese issues that really matters. These tariffs really have no real impact on China. There has to be other stuff, which is particularly intellectual property, trade secrets, and a wide range of other.
Ambassador, I don't mean to interrupt. We are out of time. We will continue this discussion. Robert Hormels are particularly strong in the Pacific Rim with Tiedemann Advisors. Lisa, this is an arch conundrum, and all I can think of is the British phrase OBE, or overcome by events. That's the only way this massive tension between international relations experts and the agreed upon Republican-Democrat resistance in Congress. It's one of the few real certitudes we have going on right now.
Yeah, a certitude amid a sea of uncertainty. And right now, ahead of the open, 30 minutes to go, I will say, I am just watching that bond stock relationship reassert itself as people get increasingly gloomy about how overcome by events turns into something that is a pendulum of gloom.
Can we agree it's a toxic brew?
I was talking specifics, but you can have your toxic
brew.
brew.
The brown can capture the toxic brew. Stay with us. Seriously, market tumult on radio, on television. Good morning.